speak in 5-6 languages here. I think all the partners are from different parts of the country. The journey of Ananya, I can't talk without touching the journey of FWWB. Friends of Women's World Banking, when we started 30 years back, so June only, 30 years back, 11 students said that we will work even though we are an affiliate of Women's World Banking, we will concentrate on low-income household women. And of course, the self-employed women, they are forming 80 to 90% of the workforce in India. So they don't have access to finance. So we have to work for that. I still remember that we shared the space with old Seva. I don't know how many of you had seen the Seva. And graciously, Seva Bank had given a space for us, even though it was a storeroom. That is where Friends of Women's World Banking started. And I still remember the first donor when they came. So I was doing the administrative work as well as running the organization. There were only 2 people. So I still remember Kathy Sridhar. I could see, she said that Kathy Sridhar is the person who can give you some money to start the work. So I could see Kathy Sridhar coming, the head and then the nose and this thing. So I was wondering how she looked like it. And I think the first set of trainings we did with women on collectivization and access to finance. SG was coming up that time, was with a grant that a lady from United States gave us. So throughout the history of FWWB, nurturing was done by different women. And yesterday I was telling you, the culmination and recognition of Indian financial sector happened in the place where we had a celebration yesterday. So that is where the meeting, we had an audacity called Vimal Jalan, 11. And all the CMDs of the banks came because Vimal Jalan was coming. So we told everybody, and then that is the place where with Women's World Banking we started recognizing the fact that even though there were only 14 organizations which were working with financial sector, have to come, and the idea about Sadhan was born there. So Sadhan actually owes its origin to So I have to speak in 5-6 languages here. I think all the partners are from different parts of the country. The journey of Ananya, I can't talk without touching the journey of FWWB. Friends of Women's World Banking, when we started 30 years back, so June only, 30 years back, 11 students said that we will work as an, even though we are an affiliate of Women's World Banking, we will concentrate on low-income household women. And of course, the self-employed women, they are forming 80 to 90% of the workforce in India. So they don't have access to finance. So we have to work for that. I still remember that.
Good afternoon and welcome to the Inclusive Finance India Summit 2020 hosted by Axis and Axis Assist and co-hosted by Niti Aayog. I'd like to thank each one of you for joining us this afternoon for the technical session titled Responding to New Policy Reform and Nudges in Agri Sector. It's my privilege to introduce the panelists for our today's session. Mr. Shaji KV, Deputy Managing Director, NABARD. Ms. Manju Agarwal, former Deputy Managing Director, State Bank of India. Mr. M. Krishna Rao, Deputy General Manager, State Bank of India, and Mr. P.S. Jaykumar, former Managing Director and CEO, Bank of Baroda. Our moderator for our today's session is Mr. N. Srinivasan. We are grateful to the speakers for agreeing our request to join this discussion. I'm positive that we'll be able to take away some concrete forward-looking recommendations for action. Welcome again, and I now hand over the session to Mr. Srinivasan to initiate the conversation.
Thank you, Kirti, and again, welcome back to all the participants. It's a privilege to be moderating a panel consisting of such experienced and expert bankers of the past and the present, with their wide experience in financing and more in agricultural financing. We expect to get rich insights on where we are and how we move forward. Without much ado, we know where agricultural finance is, which I already talked about in a presentation a short time back. With all that's there, looking at the different parts of the financing piece in agriculture, I have structured the session in short question answers from select what we call panelists out here to make it conversational. I would highly encourage the audience to send in any questions that they might have, so that we can weave that into our discussions. The entire effort will be to make this entire panel discussion into a conversational kind of a tone. None of us are going to have lectures from any podium or not having any PowerPoint presentation. I think we are done with that about 10 minutes back. I think to begin with, I'm going to ask each of the panelists to spend some 4 to 5 minutes on whether agricultural finance has changed in any way over the last about 5 years. And if it has changed, how? Is it for the good or better of the sector? And how do they look at it? Maybe I will start this with Ms. Manju Agarwal to set the ball rolling. Then I will go around.
Thank you very much, Mr. Srinivasan. I have been looking at your presentation that you made a while ago, and I was also listening to the conversation that was done by Mr. Dalbai, and I found it very informative. And you're responding to your specific question whether agriculture finance has changed over the last 5 years. My answer will be no and yes. So at the macro level, it has changed, but it has not changed for the good. You have yourself shown in your presentation that agri credit as a percentage of agri GDP has been declining over the last 5 years. Capital formation as a percentage of agri output has been declining. Share of investment credit in total bank credit has been declining. So far, for the changes that have come in, which actually are not good for the sector per se. At the micro level, if you look at, I would say there are hardly any changes. We still do the same products. We follow the same processes in assessment and delivery, and the same processes for recovery. Most of the loans are by way of KCCs, a product which has become very popular, but I would say does not take care of all the credit requirements of farmers as of date. And even this KCC, not all farmers have access to the KCC product. Almost 35% to 40% crop loans are still outside of it, though KCC has as we are saying, has lost much of its relevance in today's time. And to add salt to injury, not all farmers have access to institutional credit. We had been looking at your presentation and the earlier deliberations also, almost 35% farmers still resort to their old traditional channels for availing credit requirements. Very little work has been done by the stakeholders to look for new products, to find products which are customer specific, which could be cluster specific, which could be area specific. Very little work has been done to assess the credit requirements in a different way now that we are talking of technology and digital India. Very little work to assess the credit requirements of farmers digitally. In fact, most of the data is not available in a digital form, though we've been talking about digitizing land records. The GEM Trinity also they talked about, and we have opened so many bank accounts. Most of the farmers are expected to be on smartphones, mobile penetration we talk about. The bank accounts are linked to Aadhaar, but GEM Trinity probably stops here. The farmers are not spending money through mobile. So the digital footprints are not available. All the DBT money which goes into these accounts gets withdrawn in cash in one single day. And there are no digital footprints on the farmer's spend. So actually banks are not left with any digital transaction history which they can look at and decide on the credit worthiness of these farmers and see how they can be connected and credit linked. Very little work has been done to make agriculture sustainable and environment friendly. We have been going for monocropping. We saw how agriculture in South is still progressive, but in North India it is monocropping paddy wheat. And why paddy wheat? Because your marketing is assured, government will procure at MSP, and even though it may not be useful for the country per se, even though these crops are available at much lower rates in international market, but we continue growing the same crops because you are able to sell, your marketing is assured. So very little work has been done how we can make marketing more vibrant, such as farmers take recourse to different crops. Could be horticulture, could be pisciculture, could be aquaculture. So very little work has been done, and I'm talking of all the stakeholders, including banks. Very little work has been done for creating and financing value chains on the line of dairy finance. We have seen how dairy has become a self-sustainable industry and how people are taking benefit out of it. But other than dairy, I'm not able to find any other value chain financing in agriculture. Now, we have been talking about agriculture output and its bank's credit as a percentage of this output, but there is still some information which is more skewed. If you look at the contribution of allied agriculture activity to agriculture, it's almost 40%. But the flow of credit to this particular field is just about 9%. And this is one area where if credit is made available, it will ensure a regular revenue stream for the farmers. And the kind of stress that we talk about in agriculture, crop failures, all those problems are not there in this particular allied activity. But very little financing is going there. There's one more activity which is skewed. 85% farmers are small and marginal, and they handle about 47% of the total cropped area or the operational land holdings. But the share of credit to this particular sector is just about 9% of total agriculture. So whatever support that we talk about, that the government is giving by way of interest subsidy, by way of other input subsidy, by way of maybe MSP, I don't think this particular sector who needed the most, they are getting the benefit. It is somebody else who is getting, and very little work has been done to set this problem, to fix this problem, I would say. And last but not the least, though I am a banker, uh, the number of rural branches, when we talk about outreach, the number of rural branches are declining. They may not be declining in absolute numbers, but number of branches, rural branches, a percentage of total branches is declining, and they are being replaced by business correspondent. So business correspondent is a good concept. But business correspondent cannot replace a rural branch actually. And now these branches are, first, the numbers is going down. Second, they're not adequately staffed. You go to any rural branch, you can look at the staff strength available. Third is they are too much bogged down with the liability products.
Yeah.
Because banks have opened accounts for each and every individual and households, and government is slowly and gradually putting money into these accounts under various schemes, Kisan Samman Nidhi or some Vidhva pension, some maternity pension, scholarship, blah, 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 LPG subsidy, all kind of subsidy. So these branches are too much bogged down to handle these liability products. So where is the time to look at credit? To look at, and if you look at the average number of loan accounts that a single rural branch services, I don't think it is humanly possible for them to manage those kind of accounts. So when you cannot even manage the workload or the pressure, where is the time for the poor man to innovate or to do a field survey or to be connected with the farmer to see whether he really needs funds, where is the funding required? He is somehow trying to make the both hands meet. So we need to look at and we need to have some financial sector specialists, the agri sector specialists in the banks. There was a time we used to recruit agriculture assistant, not anymore. We have the same general cadre.
Yeah, ma'am. There are some of these issues. Maybe in a second round we will get back to. I think it's a very comprehensive set of issues that you are talking about in describing the current state and whether you have seen any change. Now I would shift to Mr. Jaikumar, having been there at the helm of affairs in Bank of Baroda and coming from a very different banking background. Mr. Jaikumar, how do you see whether agricultural finance has seen significant changes? And if there are changes, then how do you see them? Are they positive, negative? Yeah.
So the way I would compare the scenario is like this. It seems to be we are in a plane. The plane is in the boarding gate, but the expectation is that it will be in cruise mode. So I guess given a certain amount of time, surely from the boarding gate to the cruise mode should be possible. First, let's look at farm credit itself. 2015-2020 data shows 8 trillion rupees of financing. Circa 2021, 13 trillion. Average growth rates 15% CAGR, multiple times of the growth in the underlying GDP. So I would assume some of the gaps that are there in terms of access to non-institutional credit must have in some way been covered to give meaning to these numbers. On the other hand, we're also dealing with this issue, which is the gross NPA is extremely high, 8 to 10%. And if you look at the gross NPA, it is particularly elevated in states where there has been a farm waiver. Last week, I was in Chennai speaking to FPOs, and the first thing they told me is, don't lend any money now. We are expecting farm waiver to be announced in this election. Therefore, you don't get involved right now. You'll only lose money. So we need to think about that, right? Farm waiver and its implication with respect to gross NPA, we need to consider. The third thing I would like to say is that there has been a tremendous progress in the payment system. The Aadhaar card, the Jan Dhan, the various direct benefit transfer, UPI. The fact that 14.5 crore customers could get money, farmers could get money practically at the push of a button. While working in Bank of Baroda, I learned this term saturated marketing first time, which essentially is a way of saying there's 100% penetration on Jan Dhan and the other stacks covering Bima Yojana, pension program, etc. So these are certainly railroads that have been built. And surely, as time goes by, we should be able to use the railroads more effectively. Now, getting down to a little bit more theoretical, you have the Gulati and Fang report, the dragon and the elephant, and the learnings from agricultural and rural reform. And this is important to discuss. China has 103 million hectares of arable land. India has 141 million hectares of arable land. China's output is 1.2 trillion. Our output is 400 billion. So when we start thinking about it, we say, yes, there is a low capital formation in the agricultural sector. I have tried to increase the capital formation in the agricultural sector. I will give you an example and why I could not do it. In micro irrigation, if you were to look at it, Indian coverage is 15%, China's coverage is 50%. I went to Ganganagar, which is one of the better districts. And theoretically, if you brought in micro irrigation over there, a lot more people further down the chain would get water. But there is a scheme with a 90% subsidy with respect to micro irrigation. Now, the absolute amount of money available under that micro irrigation program subsidy is 1,000 crores, but everybody thinks he will get it. As a consequence, it's been impossible to convince people to make investment in micro irrigation to improve the productivity because there is a subsidy sitting over there. I spoke to these people in Chennai and told them, let us put solar water pump. They said, water is free, power is free, so why should we do it? So there you are with 90% subsidy, free power, free water. All of that essentially are inhibitors to investment in investment credit. And these things need to change. So let's look at the positive sides. The negative sides we've discussed. We are transitioning to a universal income system, which means all these subsidies will get aggregated and will be given in the form of one credit. That would give a greater degree of opportunity for farmers to accept modern technology because they will be seeing what they are paying for. They'll be paying for what they're using. And I would think that kind of a change, if it is earlier brought, would be a bit of a silver lining into this whole process. Now, speaking to the new set of reforms with respect to FPOs and APMC, and also the development of ENAM, surely it should be possible to have the output side of the equation improved. The second inhibitor in terms of farm acceptance of investment in farm investment, one of the things that the farmers kept saying is that whatever output we are getting, we're not getting fair prices. We surely can make investment and we can grow 3 times more, 4 times more. Who is going to take the output? And would not the increase in the output itself result in further fall in the price? And so then you get back to this position that we need to address this issue of demand side, of excessive supply side through a number of initiatives, food processing, agro industries, etc. But you also need to see an increase in the GDP of the people and increase in the consumption requirement of our people so that these outputs can be absorbed. And we also need to see substantial uptake in the export arrangements that are there. But on all of these things, I see, movements happening. So I would therefore say to you that there are enough number of silver linings on this whole space that should help us to look at future and say that should be better. That's really how I would put it. That's how I really would put it. I would think we need to move to a new architecture for agricultural credit. That new architecture is not going to be made by asking bank officers to work harder. It isn't going to be that. That's not the solution at all. The new architecture would simply involve the farmer going around the field of his farm, the GPS coordinates being taken, the lat long being taken, interacted with a bunch of data to give the farmer an SOP as well as a product that he should cultivate. And a surveillance system that is based a combination of space and kind of sensor technology that will enable appropriate intervention. I would very clearly see there would be very little individual action with respect to water and fertigation. The whole process would get automated. So yes, we need to improve farm credit. We need to improve farm output. But a lot of things are going to be around how quickly and easily we adapt to technology. The technology is there. And all data shows that the payback of this technology is good, provided we're able to deal with the output side of the equation in terms of being able to absorb the commodity that is getting produced. So in conclusion, I see forward movement. I see tomorrow being very different. But I do see that we have to do a lot of work between now and tomorrow to make this kind of a dream that we have into a reality. Thank you.
Thank you, Mr. Jaykumar. That's both the positive, the negative and the positive, and the emphasis on the positive as to the future direction. Mr. Krishna Rao, you are an operating banker. So how do you see the changes, if any, in agricultural finance?
Yes, sir. I really endorse the views of both the MD, DMDs, MD of Bank of Baroda and DMD of earlier State Bank of India. They talked about the macro picture and macro. Now I am confining to the operational issue, how State Bank of India for the last 2 years has taken the measures to enhance the credit flow to the outreach. one of the important step they have taken is digitization of processes.
Okay.
Digitization. We have already digitized the one important product, that is KCC, under UNO platform. The UNO Krushi app. Under the UNO Krushi app, farmer can apply his review or renewal sitting in the house with 2 or 3 clicks. This is very, very safe, simple, and secure. He can do. He need not submit any physical form. He need not come to the branch. With he can download the app and submit the application, and the everything, the process part and everything will be done by the system automation. So we have taken these measures, and we are going to connect to so many farmers. As on today, we have 80 lakh farmers. We have extended under KCC. We are this app has been launched in the month of August. We already covered 2.8 lakh farmers. They are able to process their loans through this. This is both convenient to the bank, convenient to the farmer. That digitization, not only KCC, we are digitizing for tractor loans. We are digitizing the dairy loans. We are digitizing all loans. All loans are available on UNO platform, and the farmers can access the the loan products. They can apply it, and everybody will, the process part. Our aim is to reach more to the unreached areas, unbanked areas. So we have gone to the digitization. The second step we are going to have is collaboration with fintech companies and startups. We have already identified some fintech companies. We are in the process of having a partnership and collaborations with them. With that latest technology of artificial intelligence, blockchain, big data analytics, machine IoT, we are able to leverage the market linkages and other things to both the benefit to the borrower and the bank in a big way. The third one, the strategy what State Bank of India has taken is they have launched, rolled out one new vertical, that is called FIMM. FI means financial inclusion, MM means micro market. This is headed by a very senior officer, deputy managing director, and the officer also has been shifted from Mumbai to Delhi to have a coordination with all stakeholders. And this office is focusing on deepening financial inclusion, execution, delivery, coordination, and this is nothing but a specialized outfit for the delivery of agri credit along with the BC channel. The third initiative what we have taken is we have established processing centers, hub and spoke model. For 10 to 15 branches, we have opened one processing center. That processing center is called RACC, Retail Assets Credit Center. There they do end to end. That is pre-sanction, processing, then post-sanction to support the rural branches. Thereby, the tax can be maintained. And another area where we have done good job is partnership with NBFC, that is co-lending model. Under co-lending model, we have already partnered with Paisalo. We are doing good work in this, and we have already identified another 7 NBFC ND companies. We are going to have a tie-up with them to reach out to the unreached areas, credit deficit areas. Another area where I want to bring to the August House to examine is regarding the tenant farmers. Now the tenant farmers constitute 50 to 60% of the total farming community. Andhra Pradesh has a lead. Am I audible, sir? Andhra Pradesh has taken the lead of providing LED. It is not bulb. It is a loan eligibility cards. LEC, loan eligibility cards. These loan eligibility cards are given with the government that is backup to the eligible farmers, and the farmers are eligible for the credit. they are eligible for the input subsidy, they are eligible for crop damages. This kind of initiative, if it is replicated across the India, so much of farm credit will go to the real beneficiaries, so that the institutional informal, now they are taking the loan from the informal channel, now they can be a formal channel if they are taking. Another initiative what I am requesting to the August House to consider is credit guarantee just on the lines of Mudra. Mudra is taking care of the non-land based schemes. Why not they include in land based schemes also, so that the farmers will get a comfort to lend this all these farmers, because the NPA level political risk is high in the agri finance. It will take care of for them to reduce the credit cost.
Yeah.
In a nutshell, I am talking about the initiative taken by State Bank of India for enhancing the institutional credit at affordable interest rate. That's all, sir. Thank you.
Yeah. Thank you, Mr. Krishna Rao, for a good description of what's changing in a fairly large bank, which is probably the banking sector leader. I will now turn to Mr. Shaji, who has been a retail banker and also who has been at the helm of affairs of a bank which is rural focused, now at the head of a policy bank. So Shaji, when you are dealing with that, one of the things that has changed is about use of BCs in banking. There is a question which has come from the audience, which is also asking whether the BC model is a good solution to branch banking, especially in agricultural finance. So towards the end of what you have got to say on changes in agricultural finance, if you could cover this additionally, we would be very thankful. Yeah.
So the question asked was how the agri finance has changed during the last 5 years.
Yes.
In terms of quantum, already your presentation has covered that it has increased. Mr. Jay Kumarji also has told about that. But then we have to analyze it a little further. That there was a mention that the loan amount, quantum wise, above 10 crore loans are higher. So that has dragged actually the figures higher. With that data, when you analyze it along with the number of small farm and marginal farmers which are still unbanked, and also with a data that the cooperative banks share, even though their quantum is stagnant, their share has come down. So all these points out to the fact that the quantum of agriculture finance is moving towards large farmers, which is a trend which is evident in the last 5 years. And why the share of cooperatives have come down, that also is a matter to be examined, because this was a time when PM Kisan was introduced, and PM Kisan needed Aadhaar enabled account, which many of these cooperatives were not having. Why I'm mentioning about cooperatives is that cooperatives are considered to be close to the farmers, that to small and marginal farmers, and also even sharecroppers or tenant farmers and such other things, which is the area of concern now. So what is happening is that many of the farmers are moving towards public sector banks, or maybe banks with Aadhaar enabled accounts. But then those banks are not innovating enough to meet the needs of the farmers, because KCC, as of now, I think it served its purpose. But one thing, if you see the history of KCC was launched at a time when there was no innovation happening at the bank level. So government and NABARD thought about having some innovative product, but that was a customized product for farmers. But that killed innovations. I can say that, because at the branch level, people thought it easy to lend to KCC than to other types of loans. So now KCC has served its purpose, and now during this period itself, during the last 5 years, if you see, there was a PSLC, that is Private Sector Lending Certificate, was introduced. That scheme also, what it did was that those institutions which are good in origination of loans, they were incentivized by some sort of fees through selling those PSLCs in the market. So if you see that the quantum of private sector lending certificate, it has gone up, and mostly private sector bankers are having the large quantum. So that itself shows that that is an easier way out for the private sector or private sector banks not to take risks, or not to have dirtying their hands in the agri finance, if you can tell like that, because they are not going to the field. So that is one thing. And then the RRBs, the regional rural banks, which are having access agriculture and private sector loans, they are the major players. They are major players as sellers. Whereas public sector banks, to some extent, it is there. If you go by the private sector lending shortfall, there are still major public sector banks having shortfall. That also is alarming. So is that way, if you analyze, no, we have to now think about some innovations in PSLC as well. So though there is a categorization of small farmer, marginal farmer, similar to that, why can't we have PSLC for say micro irrigation loans? Or wherever we need to focus, wherever the term lending has to happen or capital formation has to happen, how can we incentivize banks to originate those loans? At least those who are very good in origination. And as you said also, this NBFCs who are good in agri-finance and who are now the last mile connectivity, they are actually meeting the last mile connectivity even because they know the area well and they are innovating and they are adequately pricing their products as well. Whereas because of mandated lending or maybe one size fit all approach of large national banks, which itself is killing innovation at the lower level. So that also the NBFCs also should be brought into this PSLC data. And now one more trend which has happened is the collectivization. Collectivization, it started, of course, with the SHG lending, and as an offshoot, JLG came. But then after that, the FPO financing. So that also started during this last 5 years. The FPO financing, of course, the FPOs, NABARD was leading the role. Actually, they formed around 4,500 FPOs. But then finding that many of the bankers or institutional credit providers are not providing credit. The NABARD, what they did was that they forced their own subsidiary to lend to show that FPO financing is a profitable venture. In fact, as on date, one of the NABARD subsidiaries is the largest lender to FPOs, having lent to close to 400 FPOs, where no other, even the largest bank of the country, has not lent to such an extent. So now what we have done is that, as a development financial institution, we have developed as earlier SHG product, now the FPO product, and we have also crystallized the guidelines for that. And we have, in fact, through RBI, we have now circulated it to banks. But then that doesn't mean that this is to help the banks. No, what is actually happening is that, as some ex-DMD SBI told, at the field level, the rural branches are overcrowded because of liability products, or even if it is overcrowded, but that doesn't prevent these banks from innovating. So they could have, see, you asked about BC. So what all things which are routine in nature, with proper risk management practices, it can be hived away to BCs. Thereby, load at the rural branches. Of course, there are HR issues there at the regional or at the rural level. So these things can be overcome by innovation. So use of BC by banking, which actually reduce the drudgery at the field level, but then with proper risk management practices and proper technology. These are very important. So now, whether BCs can do agri lending, yes, if you properly digitize the process, and also with a lot of checks and balances. What Mr. Jaykumarji has told, that geofencing or geotagging of the land holdings, that can be a start. And one more thing. So we have a wealth of data in PM Kisan, which is actually an Aadhaar-enabled account where each and every farmer, that too small and marginal farmers, are identified. So that can be the starting point for the digitization. Now, next stage could be the geofencing, which Jaykumarji has told. This can be added to that. So some innovation has to happen in the PM Kisan data. RBI has come out with the regulatory sandbox where the anonymized data is given to AgTech providers. So similar to that, something should happen now in PM Kisan. And now there was another mention about KCC getting stagnated. So KCC getting stagnated, I take it as as a cleansing of KCC data, because there is another observation that in the southern India, the crop loaning is higher, because it is actually a wrong classification of loans. As everybody knows, gold loans are getting classified as KCCs, and so numbers get elevated. And now, because of the interest subvention and getting Aadhaar seeded to every KCC account, the numbers are now actually coming down. But then banks are not actually providing the exact number. That is why it is shown as stagnation. But then there will be some catch up with the fresh loaning. There is a catch up trying with the PM Kisan data as well. Out of 9 crore PM Kisan data, almost 50% only is covered under KCC. That means real small and marginal farmers are not getting KCC. So these are the these are the factors which have come out during the last 5 years, especially during the last 2 years after the digitization has given was given some impetus. So in between that, Government of India's flagship program of doubling income is farmers' income is there, and of course, no, that doubling farmers' income itself, no, which is now, if it is not supported by investment credit, then it will not be happening. That is one thing. Second thing is that if you see the data, medium-term loans and long-term loans in the gross credit, the proportion has gone up, but then investment credit has come down. So this shows that there is a latent distress in agri, because every medium term or long term is restructured loans. Well, in the CBS system, it will be classified as a medium term or long term loan. So that is actually taking as a, when we say that 10% NPA, we have to really add this medium term and long term, whatever incremental growth is there, also to that, because that is the distressed portfolio. So these, if you add that, then distress will again go up. What you said that interest subvention not covering the credit cost, which will be exaggerated to large extent, and it will give a little fear among the bankers. So what while concluding, what I say is that there need to be some innovation, and there are a lot of data getting built up. So on that, we have to now rope in agtech players and give them the problem, because they are now in a disbursed way. Many of the agri-tech companies are doing a lot of activities, but banks are reluctant to partner, because if banks are looking at easy solution, like end-to-end solution from a single entity, because they don't want multiple partnerships, whereas this agtech are not able to give that end-to-end solutions. So now we have to tell the real problems to agtech. So we have to engage with rather banks have to engage as a development financial institution. NABARD also will be taking up this. And then make this the whole process, the journey of agriculture credit dispensation, it will smoother. That is what I think we should go ahead with. What Jayakumarji told, that cruise phase of agri credit should happen only when we rope in all these actors, and then from the takeoff point till cruise, we have to now bridge that divide. Thank you.
Thank you, Mr. Shaji. That's fairly large, what do you call, overarching view of what the sector is about, going into the micro aspects. And I see that the repetitive themes are, can we use data? Can we bring in tech, especially agtech? Can we build some partnerships with private sector entities to provide solutions which reduce the drudgery in the last mile? Maybe use of even banking agent. Unless risk management is properly there, don't go. But then with risk management, you can do a lot. And yeah, there are some things which have remained the same. They have not changed, but there are changes taking place. I think I will come to the second set of questions. These questions, I think we are, you see, banks are now trying to become more dynamic. They should become more customer responsive. The government is trying to bring in some, what do you call, reforms in the real sector. They have facilitated entry of private sector, then in marketing, in aggregation for agriculture. Also trying to bring in a more facile contract farming framework. So do you think banks will respond to these kind of changes? In what ways the banks should respond to these changes? So I would start, what do you call this, with Ms. Agarwal first, and then Mr. Shaji. Can you keep the answers fairly, what do you call, short, because we have got another couple of rounds to go. Yeah.
Actually, if you go by the three reforms that the government is trying to bring in, and the country is seeing a lot of resistance, I think that will unshackle the agriculture sector actually, if those reforms can be implemented. Actually, too much of government subsidy, as Mr. Jayakumar had been talking about, too much of subsidy, too much of interest subvention, MSP, it has actually crippled agriculture. The government funding is getting pocketed by a few large players, I would say, and the real people who need it, they are getting deprived of it. So if farm produce can be taken from, say, not to only to the APMC, but to a market where that produce is needed, and a private equity player can come in to take this farm produce from A to B, the realization for the farmer is going to increase. We all know that whatever consumer pays, only a fraction of that goes to the farm. If whatever we as a consumer are paying and the farmer gets that money, probably the whole problem of farm productivity being low and agriculture being unprofitable and farmers not getting enough remuneration, all this problem will go away. The problem is whatever the consumer pays, only a fraction goes to the farmer. And the moment we unshackle this from the APMC and he is given freedom to store it, move it to another place where he can get a better realization, or we give him an opportunity where it can be processed, stored, sold at a subsequent date when price realization is better, or give him an opportunity to export. Probably all these issues that we had been talking about can be addressed, and it will open whole new vistas of lending for the banks, and banks probably will be the best beneficiary out of the whole exercise, because currently what they have been doing only small value lending, traditional lending. The risk of crop failure is there, and when the remuneration is lower, profitability is lower, the risk of repayment is there, the credit costs go up. The moment you give large value lending to players who are able to pass on the benefits of these fruits to the farmer, everybody in the along the value chain is going to be benefited. So my view, it's a yes from me, and we should actually go. It's very sad that the country is witnessing this kind of resistance. In fact, if I meet 10 people during the day, I talk to each of them, anybody who is into agriculture in some little way, how these laws are going to benefit the community, and they should spread the message and the word and trying to take away the resistance from the people or the vested interest who are trying to bring it in.
Thank you, ma'am. On that, meaning it's a positive from every point of view. Mr. Shaji, the question, I would just elaborate it a bit. Do you see banks now coming in, say, okay, we are now going to finance private sector for setting up market infrastructure, platforms, maybe warehouses, maybe cold chain, logistics, quality assay mechanisms, or say we are now going to design products for financing, say again purchase contracts issued in contract forming. Do you see that banks are going to come in a larger way? And what do you think might be the kind of preparations they may need?
So there's no doubt that these legislations are path-breaking, and it will be positive. That is all. Everything is there. But the problem now is that we have to now ring-fence the risks associated. No, there is a pre-production risk. That is the crop production risk is there, where weather insurance and such other things are not yet stabilized. That is one point. Second, this post-production risk, which the new laws are trying to address. That I think we have to now develop a good commodity market. Now, as of now, the minimum support price, which is acting as the implied put option, because whatever you produce at that rate, there's an insurance to the farmer right now. But then it is not a it is not a stable put option, because it is not a market linked one. So we need to go towards a market determined mechanism. For that, the commodity markets, of course, now around 7 commodities, agri commodities, there are commodity futures and options are there. But then we need to we need to develop volumes in that. We need to create a lot of liquidity there. For that, I think there is an understanding now that there will be some sort of consolidation in the stock exchanges as well. And then there is a credit guarantee. So when banks are assured of reasonable security for their loans, banks will be lending. But I doubt whether banks are right now, mostly public sector banks, whether they are thinking in those directions. I doubt. So what we are doing is that we are trying to create some demonstrative effect in converting these cooperative societies as multi-service centers. So what we are trying to do is that we are under the Agri Infra Fund. What we are giving loan to PACs, that is by primary agriculture credit societies, at 4% rate of interest, which with the interest subvention, it will be costing at only 1%. So around 15,000 crores we have set apart for that. So that will create some infrastructure, because one of the requirements for a robust commodity market is to have proper post-harvest management infrastructure. So that is what we are trying to set up. And then once that is there, we are now thinking of also subsidizing. No, there's the premium option premiums in the commodity markets. Whether we can do that. No, whatever around what you assessed is that for every contract around 500 rupees of so premium is coming. So some sort of subsidization there to attract, not that subsidy should destroy, but then to attract more of participants into this field, mostly through FPO, marketing techniques. So now this innovation which has to happen in public sector banks. One more thing is there, no, the public sector bank with one size fit all approach will not serve the purpose. What they have to do is that they have to partner with a lot of NBFCs who knows how to handle these things, and then as a co-lending opportunity or a co-development opportunity, they should come out. And then the states are also because agriculture being state subject as well, states also should be actively partnering. I think in this direction, Andhra Pradesh and Telangana are leading, because what they are trying to do is that they are actually coming out with the crop planning, because of the excess land now is coming under cropped area due to a lot of irrigation projects which are coming up. They are now going in a structured manner. We are also guiding them so that there will not be any glut. No, what actually is happening now is that earlier we used to have food insecurity. Now we are dealing with food surplus. But then food surplus is very much skewed towards cereal crops, which has to be diversified. Now, see, people have to move away from cereal crops to from cereal crops to other oil seeds and such other crops, where country is now depending on import. So that's some sort of an import substitution, which our Prime Minister has told about Atmanirbhar. So we have to now go forward to those crops where import substitution can happen. Thereby, we can save.
Hello.
Sir, can I add one point, sir? I'm Krishnara from State Bank.
I think, did we lose Mr. Shaji's link? Yeah, Mr. Krishna. Yeah.
I think I have lost in between. Am I audible now?
Yeah, you are audible, yes.
Yeah. Okay. So I think, I don't know where I lost connection. So what I was telling is that there should be some sort of innovation from the public sector banks. I'll ask, and then we
Again. I think we have lost him again.
Sir, can I add one point in response to the DMD?
Yeah, please do, Mr. Krishna Rao. When Mr. Shaji checks in, I will ask him to continue later. Yeah.
Sir, in respect of private mandi, in respect of private mandis, in response to the agri laws, 3 laws, yesterday we had a detailed meeting with one of the important constituents about the product and pricing. We have already finalized the product and we have already going for other pricing. They wanted a special pricing for the sourcing and collection. That kind of arrangements we are entering with one of the important players.
Yeah.
That is the update I am sharing with it. Another one update is actually, agriculture is challenged by with the 3 P's. One is a production risk, 1 P. The second one is a price risk. The third one is a political risk. Actually, in the production risk, what we are suggesting is, instead of cereals, we are encouraging commercial crops, either vegetables, fruits, and other tobacco crops, where we are giving special pricing, special security arrangements. Also, we are reducing them. So indirectly, we are encouraging them to go from a cereal crop to commercial crop. Another area where we are just now we are entering is options. So far, we have not done anything options for price risk against the commodity. Now we are with NCDX multi-commodity exchange. We are going to enter a options.
Yeah.
That instrument also we want to this one. So I want to add one is a product customization we are doing. in response to the agri laws. Another one is the option also we are trying.
Right.
The third one is pricing also we are giving to the commercial area. Thank you, sir.
Yeah, thank you, Mr. Krishna Rao. I think I will move to the next question now. I will start with Mr. Jaikumar on this. You see, we have seen quite a bit of subsidies, then some kind of subventions, grants also come in through specified projects, investment, what do you call, subsidies for setting up warehouses, cold stores, livestock sector, even fisheries sector. We have seen it in the past. Plus these interest subvention kind of things also continue almost for more than, what do you call, 15 years, almost it is 15 years after interest subvention started. When banks are involved in financing, are they able to adequately price in the kind of risks given the environment where government says farmers require a low rate of interest, farmers expect that they will get loans at a very cheap rate, and at these rates, is it possible to carry on a business where we expect very large volumes of credit to get in? Do you have any thoughts on what might be some structural kind of responses to this? And how do we take this forward? Because you have seen it from an outside bank, from within public sector, and also now in the process of doing a private sector entry. I think this is one piece which we don't openly voice out in terms of financial sector policy, how it nudges or how it pushes banks away. Yeah. Muted, Mr. Jaikumar, you are unmuted.
I'm sorry. What I said was it would all depend upon how we are able to build in scale and improve productivity. I'll give you a few examples of them and as some kind of a marker. A long time back in 2016 or something, the bank I was working with bought a bank in Korea. So I had gone with them to spend time on the mortgage business of the country. So I asked him, how do you verify income? He said, we don't ask for income. I asked him, how do you verify the property value? He said, we don't ask for property value. I asked him, how do you verify the title? He said, we don't verify title. Then I asked him, how is it possible to give a mortgage loan where you don't ask for income, don't ask for verification, don't ask for title? Would it not be a dangerous thing to do? And the answer to this is like this. In Korea, there is a bureau you ping, you get your salary. There is a bureau you ping, you get the credit score, like we do. There's a bureau you ping, it confirms the title deed, who owns it, etc. The transfer can be made from the bank's desk. You can completely change the registration process. Now think about that system. And that system is so efficient that the cost of processing a loan in Korea is cheaper than the cost of processing a loan in Chennai, where you have to search for the 30 years of title record. You need to engage a lawyer. It takes 90 days and at every stage you're waiting. You see, the answer to all of these questions comes back to the principal thing. Productivity improvement has to be substantially done across board. That I think would help. And the second thing I would say is the farmer's income increases. They see the value of the credit facility being provided to them. They see the value of maintaining the banking relationship in proper shape. So I think we go back to the same thing. How do we improve productivity and how do we improve the placement of the output? If people are earning well and they can afford repayment, they will repay. Fundamentally, there'll be some who won't, but most will. So I see this more as how do we build the scale. One last example, collection. We go to a village. This particular parcel of land is financed by SBI. The next parcel of land is financed by Bank of Baroda. The third parcel of bank is financed by Indian Bank. Now look at the collection cost. Each one of them is coming to that little portion of land, collecting the money and moving. Some of these things can be integrated into a single platform that can help in lowering productivity. Finally, the farm law itself. We now created we have multiple platforms. We have ENAM. Now under the farm law, you can sell to anybody. So there is going to be a trade market that is evolving. And then you have the APMC, which each state a different level of liberalization. If you were to integrate this market platform, you'll have better pricing coming out of the whole exercise. So to answer your question, long and short, I think the improvement in productivity, reduction in cost, and the scale factor are critical. If these things can be accomplished, then the pricing would then tend to become competitive in the way it is. So I hope I answered that question. And finally, we need to relook at all of these subsidies. I think we need to move to one universal income so that subsidies don't become perverse in nature and create their own distortion. Thank you.
Yeah, thank you, Mr. Jayakumar. That more comprehensive response, which most bankers would like. You try and improve productivity within the bank by having digital processes, access to information in a form that you require. Also, you improve productivity, profitability in agriculture. But on the last point, you said, look, you try and take subsidies away, let them not pollute what the financial sector does, keep it outside, give it as a universal basic income. So the farmer's livelihood is protected. The financial sector gets on with its job. I think fabulous.
This is one other point. When we talk about digitization, we have to talk about digitization of the real sector along with the financial
Yes,
sector.
financial.
Right? So land records have to be digitized. A lot of real sector changes have to happen. It is then you get the full benefit of digitization. Otherwise, the bank simply improving the process won't help unless the real world also improves the process. So the financial world and the real world moving in tandem.
Absolutely. Absolutely. Mr. Krishnarao, now I will turn to you on the same question. I would just like to ask the question that will be more specific on this. So when State Bank is the largest bank in terms of even agricultural finance, it has lots of innovation, which you yourself have listed out in the last 2-3 years. What are all the things that have changed? How is the bank able to price its what do you call loan products and price its risks? Because one set of loans have to be given at 5. There is another set which we will have to give more. How do we actually manage this?
Sir, for determining the pricing, we are using the two models. One is up to 50 lakhs, we are using a credit scoring model. The above 50 lakhs, we are using a CRA model, credit risk model. These two models we are using for financing high value investment credit. Actually, investment credit, if you see the declining share of investment credit in State Bank of India also for the last 3 years. For that, we are introducing this now instead of linking to MCLR, that is marginal cost of funds based lending. Now we are linking to EBLR, that is external benchmark lending rate. Thereby, suppose take for example, one example I will tell. Yesterday we have linked to MCLR, 1 year MCLR plus 2. 1 year MCLR State Bank of India is 7 plus 2. Now it is 9%. Now we have decided all term loans should be linked to only EBLR. Our EBLR is 2.65 plus 4. That is our repo rate. So 6.65 plus 2, 8.65. So the pricing is linked. One is the linking of the base rate, that is EBLR. We have moved to the EBLR where they will get a 30 to 35 BPS benefit to the farmer. The second one is if they are able to get a good score, we are able to give a good loan limit and the price also. In fact, you will be surprised if they have very good CRA. We are giving a very fine rate, even for a 20 crores, 30 crores also. In fact, I will tell you one example of Agri Infrastructure Fund. Agri Infrastructure Fund and Agri Animal Husbandry Fund. First time we have introduced up to 100 crores. Thanks to the NABARD, up to 100 crores rate of interest is only 8.65, irrespective of this one. Because of this, inbuilt risks of credit guarantee is providing. As long as credit guarantee is provided, as long as the risk is taken care of, we are able to translate the benefit of pricing to the common man, especially farmer who are investing in the investment credit.
Thank you, Mr. Rao, for the detailed answer from the State Bank side. I will now move to the next question. Now we are running out of time. We have, I think, as allowed by Kirti, another about 8 or 9 minutes. This question, I'm going to combine the last two questions basically. One is, we have discussed quite a bit about the need for bringing in new types of lending, innovating, moving away from KCC for certain reasons and all that. I only wanted to ask, what do you think about the feasibility that banks will shift entirely over to value chain based lending? Some of you already talked about the ecosystem requirements in terms of data, digitization of the real sector, the farms and their outputs and farmer holdings and all other things. So looking to how things are happening on the ground, digitization of land records and the credit registries that are coming up now, do you think banks will be in a position to almost fully, if not fully, shift to value chain based lending? And also the last round question, what are those three important policy changes you would like to see to make agricultural finance much more vibrant? I start with Mr. Shaji on this.
Yeah. So regarding this value chain lending, I think banks should. It is high time that banks should move towards that, because now collateral based or no the no person based lending should not no longer happen. It should be transaction based lending which should happen. So if you finance a higher up the value chain, that money should flow to the production producer, that is the farmer. That also we should do it. For that to happen, there should be some infrastructure, marketing infrastructure, such other things need to be there. Plus, of course, the de-risking, the post-harvest de-risking has to happen. Once that assurance is given, or that is there, then I think banks, but then banks on their own way, they can do it by, as I said earlier, by partnering with NBFCs. So NBFCs I've seen, no, earlier one question was asked whether rate of interest. Actually, I don't think it is a rate which matters. It is the timeliness and adequateness of the credit. That too offer a small and marginal farmer who is not getting, and now he's going to alternate sources where no the rates are very high. So studies have proved that once that credit is given at the right time at the adequate quantities, his productivity will increase. So that will take care of the cost. Even if he has to pay a little higher cost. NBFCs are lending at say 15 to 16%. In our own case, when FPO financing is not happening, when our subsidiary is lending at 13%, still demand is very huge. Whereas if a bank is trying to lend, if say a bank like State Bank of India, they may price it at around 8%. But then we are able to push the credit at 13%, that too no, at a profitable manner. So it is not the rate which matters, but the timeliness and the adequateness of the credit which matters. But of course, rate should be at a reasonable cost. So now coming back to this value chain financing, we have taken some certain steps like geotagging of warehouse to build up the database. And one more thing which we are trying to push is the agri stack, where we are trying to capture all the rural transactions which are happening, where we will build a data stack just like the India stack which is there. Of course, on PM Kisan database, we are in talks with government. So once that happens, I think that should be a facilitator. We'll develop a platform where any player come with API integration, he can do some innovation and then demonstrate to banks that no value chain financing can happen in all the stages of value chain. But then one more thing here, it is that the APMCs who are now just in a part of supply chain, they have to be created, they have to be rebranded as a partner to the value chain. They should just no, they should not do the transaction of procuring and giving to FCI. Instead of that, they should now be part of supply chain. That will be a welcome step as a result of this legislation which is coming. So now on the policy part, what I feel is that no, we should now facilitate NBFCs to access low cost credit. Maybe, as I said earlier, that no PSLC lending, they should be able to issue certificates, PSLCs, to those banks which are which are deficient in priority sector credit. That will give a lot of impetus to the rural lending, where the NBFCs is still, they are gaining actually the market share. Almost 10% of the agri market share is with the NBFCs. Now, if we reduce their cost of funds, of course, we have given that SLF for the as a COVID response with the nudge from RBI and the government. They have provided some low cost funds which we are trying to pass on to small value NBFCs. But still, their cost of funds need to be reduced. They are the persons who are now will provide effective last mile connectivity. So we need to have a proper legislation on that. And then state governments should come with an active participation and FPO. They should now try to consolidate land holdings as a group, maybe under a cooperative structure or maybe as a company, whatever it is. But then the choice of the institution should be left to the state government. But there should be some mandated type of thing for collectivization of small and marginal farmers. Then this credit guarantee scheme, as you said, we have to de-risk lending. So as a small step under AIF, some credit guarantee is now given. Under Animal Husbandry Infrastructure Development Fund, NABARD has set up a subsidiary, and through that we will be giving the credit guarantee. Now we are trying to explore the possibilities of extending that credit guarantee to other types of loans as well. So we are in talks with the government. So more hopefully, if that happens, then on our own way, we also will, from our own funds, we'll provide the corpus partially. But then normally credit guarantee should be given by sovereign. That is what no, we because it's a default guarantee which is giving. But then with proper proper checks and balances, I think we can structure a good credit guarantee product at the initial stages, because these are all in the fledgling stage where we are trying to liberalize the farm sector. So we need to provide some incentives for the players to come in, to provide them reasonable safety for their funds lent. So on those matters, we have to move forward. I'm sure in the days to come, it is the days for agriculture sector, and that too the agri export. That is what the new agri export policy has come. Even NABARD is now has tied up with APIDA for capacity building in agri export area. So because a lot of phytosanitary measures, a lot of other legislative measures are there, a lot of educative activities have to happen. So we will be taking lead on that. That's what for the time being I am.
Thank you, Mr. Shaji. Mr. Krishnarao, would you like to come in on this specific thing? How feasible it is that, say, State Bank will shift over to value chains?
Sir, I can say we are the leaders in value chain, especially in the entire 7 states of Northeast. We have already rolled out a value chain. To start with Tripura, we have entered a recently value chain financing for fisheries.
Okay.
From input to output. Actually, what is happening in the present context, 1/3 of the consumer price only producer is getting. Now, under value chain, we are aiming at to minimum 60% of the consumer price, the producer will get it.
Okay.
We are going to finance both agri and SME under entire value chain under Mudra model, so that all small and marginal farmers are going to be get benefited. And we are taking the help of the FPOs also in a big way. FPOs and tie up with companies. In fact, we have recently entered with NGOs sponsored by Tata. That NGOs also we have entered with them for sourcing the application and helping for the stabilization and standardization of agri value chain financing specific areas. Each state we have taken one value chain. Kiwi we have taken in one state, and another one is fishery, another one is piggery. Likewise,
Mr.
we
Krishna,
already
I see that
started
State Bank
in one area.
Mr. Krishna Rao, I see that State Bank is really progressing on value chain financing. It's very good to know that. Would you also like to very briefly indicate whether there are policy changes that you are looking at, any 3 of them? Because now we have run out of time. We have about a minute left. I'm so sorry to interrupt you. Policy changes, if you can bullet list it.
Only policy change in the issued contract farming, protection to the farmers.
Okay. That is the one policy change you are looking forward to.
Yes.
Yeah. And Ms. Manju Agarwal, can I now come to you for a very quick comment on, is it possible that banks will shift to value chain finance significantly, and 3 policy changes in terms of priority that you are looking at? Can you bulletize that?
Yeah. Yes, banks would love to shift to value chain financing, and the way forward could be collaboration with NBFC that Mr. Shaji spoke about.
Yeah.
Lending through FPU model. FPU can bring the same value as GLG model has brought into microfinance. And government subsidy, the funds which are getting spent through subsidy model should actually get moved to crop insurance or investment into infrastructure, because which will improve the credit absorption capacity of the farmer. FPOs can actually aggregate small land holdings with the latest technology, export extension services, and bring the marketing concept to the small and marginal farmer. So FPO lending is the way forward. And the agriculture reforms that I would support are the 3 reforms the government has brought in one part.
Thank you, ma'am. And Mr. Jaykumar, I am going to give you the last word on this. Yes.
No, I think the supply chain finance program today in most, or value chain, is for most part focused on the first derivative. That is the relationship between the first point of financing and the second node. We need to build it sequentially all the way down to the end point, and that would require development of both technology, artificial intelligence, and some form of blockchain technology. So if you were to take a simple thing of a tomato ketchup manufacturer, he tends to produce his goods at one point of time when the demand for ketchup is kind of every day the same. The ability of the financial system, therefore, to finance each of the elements, each of the players in the system, based on the quantity of goods they need to hold, and making sure the finance of the chain is complete, requires certain amount of investment in technology, in mathematical modeling, and surveillance processes. So this has to precede before large-scale adoption of a value chain. Otherwise, value chain will remain a first derivative financing. That's broadly what I would say. As far as laws are concerned, sir, there are many of them today. The issue in India is not the lack of law. The issue in India has always been the implementation of law. We have never been able to enforce a single mortgage in an agricultural land as a case in point. So I think if you had to just respect Contract Act and honor Contract Act, I think we would go a long way in terms of the way forward. And I think we are failing in the first step. You can create another 20 more act. People can violate. Nothing will happen. Today, you see how NCLT is. It's not producing any result. So we are sitting over here passing more laws and hoping that will solve the problem. It is not. It's implementation that matters.
Thank you, Mr. Jaykumar. I think, and thank you all the panelists. It has been a highly engaging discussion, full of insights, and quite a number of diverse points of view, but they are all converging on the theme of, yeah, it is possible to do better agricultural finance. Banks are already moving quite a bit. Value chain financing is possible. Only the ecosystem issues, whether it is data availability, digitization, simplification of processes. So these we need to actually look into. And some of the key points that came was, okay, we should facilitate maybe NBFCs and other non-banks to participate much more effectively in agriculture, try and reduce their cost of entry, cost of operations, cost of funds, so that they can do the last mile. Partnerships are very much required to bring agtechs in, and also to bring last mile connectivity for very highly distributed holdings of small farms. And the structures like guarantee funds and credit registries and information networks from where banks can actually take data without having to do detailed KYCs. And contract farming, it can actually boost things. And yeah, let us look at government subsidies in a very different way and focus on FPOs. And I think the agricultural reforms which focus on markets, which bring in more of private sector, which provide solutions to farmers that don't depend on the public exchequer, they may be really a good way forward when we are commercializing. I should only say here, when you put a group of bankers to discuss agricultural finance, normally the discussion will turn to the financial sector, the risk, the NPA, the difficulty of dealing. But in the panel, we had a very pleasant, different kind of conversation. How you deal with the real sector issues so that agricultural finance can maximize its delivery and improve its offering. So thank you all. Thank you, the entire set of audience. Thank you for your participation. And over to you, Kirti, now.
Thank you, Mr. Srinivasan, for directing this panel so very well and moderating it with very pointed questions. Thank you, panelists, for a great learning and participatory session. We'll reconvene after a short while for the next session titled Potential of Agri-Fintech in Improving Affordable Access to Finance for Farmers. Thank you, everyone.
I have to speak in 5-6 languages here. I think all the partners are from different parts of the country. The journey of Ananya, I can't talk without touching the journey of FWWB. Friends of Women's World Banking, when we started 30 years back, so June only, 30 years back, 11 students said that we will work even though we are an affiliate of Women's World Banking, we will concentrate on low-income household women. And of course, the self-employed women, they are forming 80 to 90% of the workforce in India. So they don't have access to finance. So we have to work for that. I still remember that we shared the space with old Seva. I don't know how many of you had seen the Seva. And graciously, Seva Bank had given a space for us, even though it was a storeroom. That is where Friends of Women's World Banking started. And I still remember the first donor when they came. So I was doing the administrative work as well as running the organization. There were only 2 people. So I still remember Kathy Sridhar. I could see, she said that Kathy Sridhar is the person who can give you some money to start the work. So I could see Kathy Sridhar coming, the head and then the nose and this thing. So I was wondering how she looked like it. And I think the first set of trainings we did with women on collectivization and access to finance. SG was coming up that time, was with a grant that a lady from United States gave us. So throughout the history of FWWB, nurturing was done by different women. And yesterday I was telling you, the culmination and recognition of Indian financial sector happened in the place where we had a celebration yesterday. So that is where the meeting, we had a audacity called Vimal Jalan, 11. And all the CMDs of the banks came because Vimal Jalan was coming. So we told everybody, and then that is the place where with Women's World Banking we started recognizing the fact that even though there were only 14 organizations which were working with financial sector, have to come, and the idea about Sadhan was born there. So Sadhan actually owes its origin to Ahmedabad. So, and the next meeting we had was in Seva Bank, and then we decided to set up Sadhan. So as 11 says, it is the women finance capital of India, because Seva was there, and Friends of Women's World Banking, which was working with partners like you, was there. And we were actually borrowing money from formal financial sector and repaying money, like the way our customers were doing it, we were also repaying money on time. Then we believed in collectives and cooperatives, but somehow there was a change because the growth was much higher, and then people have to expand, and then cooperative laws were different. It's a state subject. So the microfinance sector emerged. So the first time when we were working, all of them were development institutions. And it is only thanks to the regulation that has come from RBI, then we became MFI, NBFC MFIs. But I was sharing with some of the partners, the debate was very hot in those days when they were in the development mode. So we used to discuss, okay, this is we have to work with migrants, and we have to work with Dalits, and then we have to work with what kind of products and services we have to do. That debate I miss now, because the kind of a debate that used to happen, and people used to spend lots of time on that, it doesn't happen. Now I feel that it is how to raise money, and then who are the investors, and then whether they are social investors or not, and what do they expect, and then it stops with that. So maybe that is the way things grow. But I still feel that it is important for Ananya, which has started working with women collectives, and then it inherited the philosophy of FWWB. The debate should come forward. I think it is time for us to discuss. And then quite concerned that the kind of emerging leadership which we saw, again it has gone down. So we have to work out how women can become leaders in managing money, whatever form it is, and how you use them.
Good afternoon and welcome to the Inclusive Finance India Summit 2020, hosted by Axis and Axis Assist and co-hosted by Niti Aayog. I'd like to thank each one of you for joining us this evening for a technical session titled Potential of Agri-FinTech in Improving Affordable Access to Finance for Farmers. This session is being hosted in partnership with Rabo Foundation, the social fund of Rabo Bank, focused on helping people become self-reliant and focusing on access to finance and supporting small producers. It is my privilege to introduce the panelists for our today's session. Mr. Anil Kumar SG, founder and CEO of Samunati Financial Intermediation and Services Private Limited. Mr. Arjun Aluwalia, founder and CEO, Jai Kisan. Mr. Pradeep Basu, co-founder and CEO, SatSure. Mr. Albert Bogard, Head Innovation, Rabo Foundation. Ms. Devleena Bhattacharjee, founder and CEO, Numer 8. Mr. Raul Ribello, Senior Vice President and Head Rural Lending and Financial Inclusion, Axis Bank. Mr. Hemendra Mathur, co-founder Think Ag, is our lead presenter for today's session. And the panel will be moderated by Mr. Arindom Datta, Executive Director and Head of Rural Development Banking, Rabo Bank. We are grateful to the speakers for agreeing to our request to join this discussion. I'm positive that we'll be able to take away some concrete, forward-looking recommendations for action. Welcome again, and I now hand over the session to Mr. Arindom Datta to initiate the conversation.
Oh, very warm afternoon to everyone, and thank you, Kirti, and to Access Development Services for getting us all together. This is the first time in 17 years history of the Indian Financial Inclusion Summit that we have a session on farmer financing, leveraging AgTech and AgFinTech platforms. A great day. I hope we have a lot of eyeballs for the session now that India has won the test match, a historic test match. And it's a pleasure to be moderating a session where we have the promoters of few of the leading AgTech, AgFinTech platforms in India. We have the head of agribusiness of one of India's largest private sector banks, and we have the CEO of India's leading agri supply chain financing NBFC, our new age NBFC. It's also a privilege to have Albert Bogard with us, a person who has deep insight into all the AgFinTech initiatives across the globe, who will give us a very good perspective of where we are in India in terms of AgFinTech, farmer financing, leveraging technology. And Hemendra will start off with a presentation on the current status and potential for leveraging and unlocking capital for smallholder farmers. And before I invite Hemendra, just a couple of terms. Now, the hypothesis is that AgFinTech and technology is going to cut down on risk cost. It's going to cut down on transaction costs, which has been the biggest bane for farmer financing by the mainstream financial institutions in India. So with the process of digitization that's on and being led by some of the champions who are there in the group, we do hope that over a period of time, we'll see the unlocking of capital so that the farmers receive quality financing at very affordable rates. Now it's going to take its own time, and this discussion will explore all the different kind of structures which are possible, what the potential is. And to kick off the panel discussion, I would like to first invite Hemendra to make a short 10 minutes presentation, please.
Thanks, Arindam, and thanks to Access India team for giving this wonderful opportunity. I'm privileged to be part of this panel. Let me just share my screen. Arindam, can you see it?
Yeah, carry on, please.
Okay, thank you. Thanks. So I'll just take 8 to 10 minutes to set the ball rolling. There are many more people in this panel who can talk much more about this subject than I can, but let me just set the context with this presentation. So the topic, as Arindam mentioned, is the role of agri-tech and fintech in improving affordable finance for farmers. Let me start with the first slide, which I am sure most of you will be familiar with. It gives an idea of the agri landscape in India. We are a country of smallholder farmers, with more than 85% of the farmers having land less than 2 hectares, the average being 1.08 hectares, and it is coming down consistently as land is getting divided year on year. Another important data point I want to share, that the average income of an Indian farmer is about $1,200 to $1,500 a year, right? And if you look at his P&L account, we'll find that he has a decent and gross margin, a reasonable EBITDA, but when it's come to the profit, the net profit, it's either negative or negligible. And one of the key reasons for that is high degree of interest cost, right? Another data point which is not there on the slide, but it's very important, a significant part of Indian farming is now leased farming. We don't have the accurate data on that, but my sort of research, which I keep on doing when I go to villages, it's quite possible that 30 to 40% of farmers in India are doing farm on leased land. And that also has a huge implication on their ability to borrow. So when it comes to financing, if you look at this slide, I think this slide is has a lot of data. But the key takeaway from this slide is that if you look at the overall landscape, out of about 146 million farmers, only 30% farmers have access to formal credit, right? So I think that is one of the biggest challenge that all of us are facing and need to solve for. It's a conundrum, 30% of the farming population getting loans at 7%, and balance at 70%, which is borrowing from informal sources, is getting at a rate as high as 30%, right? So clearly, if you look at the weighted average cost of capital for a farmer, it's more than 20%. That's how many businesses in the world make money when the cost of capital is over and about 20%. On a lighter side, not many venture capital fund that kind of money on a portfolio basis. So how do you expect a poor farmer to make money with that cost of capital? So I think the biggest challenge that we are facing and we need to solve for is access to capital as well as reducing the cost of capital. Having said that, yes, there are challenges. We all know the government has very ambitious targets on priority sector lending. It's about 15 lakh crores or $180 billion for the last financial year. But bankers face challenges across the crop loan cycle, right from farmer acquisition to estimating farmer creditworthiness, linking credit to inputs, and how to monitor your loans, and all the way to loan recovery. And as Arindam mentioned, the challenge is data and digitization, which has been non-existent. It's changing for good, but there are multiple data points which banker needs on farmer KYC, on getting authenticated and real-time data on farmer crops, farm area, assessment of his income, which could be from crops and ancillary activities, assessment of his assets, and also his credit behavior, right? Another important dimension, when you give loan to farms, you need to make sure it is used for farm-related inputs. I think that's another challenge which bankers have. Then how do we monitor millions of such loans when you're giving it to farmers, given the fact the crop cycles are typically 3 to 5 months? And last but not the least, the recovery part, from individual farmers. So let's say farmer is doing 2 crop cycles in a year. It essentially means after every 3 or 4 months, you're going back to the farmers to kind of recover your loans. So there are multiple challenges, and of course then challenges of loan waivers, etc., which I'm sure we'll discuss about it. And likewise, if you look at post-harvest finance, similar challenges, onboarding farmers, valuation of assets, because still the processes for grading of commodities are kind of time-taking or not affordable. Monitoring of those assets in warehouses or processing facilities is another challenge. And how do you liquidate assets to get your loan back? I think there are challenges on that front too. And last but not the least, ancillary industries, which also is an important source of farm income, like dairy, poultry, aqua, etc. They also are under-penetrated when it comes to institutional credit. And again, we need a lot of data and digitization. And I'm fortunate to have Anil, Pradeep, Devlina, Arjun on the call who are much better versed with this, and I'll let them talk about it. So overall, what role agri fintech can play in crop loans? Again, I would say these are early days, so it's not that we have a fixed template which we can follow. But yes, there are some very positive signs right now, which can potentially solve for a lot of bankers' challenges that we discussed. So as far as farmer onboarding is concerned, I think the platforms which are supplying agri inputs to farmers, are very well placed to play that role, because they typically have a phygital model with someone on the ground and some information being shared on digitally. So these are the players who can be the right candidates for onboarding farmers, doing the necessary KYC check. So I think that's one category, and I put down some names. I'm sure a lot of you will be familiar with them, like Dehat, Big Heart, AgroStar, Gramophone. Each of them are strong in a particular region or a geography. So I think collectively, they can represent a large part of a farming population, and help banks in getting farmers on board. And second type of startups is the fintech startups, who have done a phenomenal job in being the first mile, giving the first mile access to the farmers. I again put down some names like Hakdarshak, Awaz, they Frontier Markets. Most of them are still in the urban areas, but the kind of expertise they have, the kind of digital tool they have developed, can very well be used in farmer onboarding. When it comes to credit worthiness, risk assessment, and even, let's say, risk monitoring post disbursement, I would say startups like Satshore or a Cropin or a Mental Labs, who can monitor farm area using tools like satellite imagery or drones, are very well placed to do that. They can, with those images, you can detect farm boundaries, you can detect what crop is being grown. You can also do some estimation on yield, which can give a very good handle to the bankers on the value of the assets, the value of the crop assets, and the potential income which farmer may earn. And even post disbursement, they can guide the bankers if there are any red flags, if there is any event, a weather event, for example, which can cause damage to crops. They can also do a lot of monitoring after the loan is given. And of course, players like Samunati, Jai Kisan, they're on the call. I think they are also very, very important in building credit scoring models for farmer and farmer organizations, because they understand that segment really well. Sometimes you have credit history, sometimes you don't. So you also need to rely on a lot of alternate data points to come to a reasonable score. So I think that is work in progress, but I'm sure as we collect more and more data, our scores are going to get better and better. Linking credit to inputs, again, startups, which is agri fintech or agri input e-commerce players, I think again they have a role to play. And last but not the least, on the loan recovery, I think that's been one of the challenges. A lot of models are not able to scale on loan recovering from individual farmers, right? So the best way to solve for that is to work with startups who are on the buying side, and places like Samunati are playing that role, linking farmers to the markets. And of course, a startup like Ninja Cart or a Waycool or a Shop Kirana, who are building farm to fork supply chain, they typically have a lot of farmers, a lot of sourcing directly from farmers. So there could be a tripartite agreement between the banks, these market linkage startups, and the farmers, so that instead of recovering loans from individual farmers, you go to these guys, settle the loan, and pay the balance to the farmers. Right. Likewise, on the post-harvest credit, the biggest challenge is valuation of assets. Because the multiple grades, multiple quality standards, there are hundreds of commodities. How do you solve for it? Of course, there's a laboratory setup, which a lot of warehouses and processing companies have, but it's time-taking and it, of course, is costly. Fortunately, we are in an era where a lot of image processing is being used for quality assaying, and I put down more than half a dozen names on this slide who are doing brilliant job in doing that quality assessment using the images which is being captured through mobile phones or through spectrometers. And these are portable solution, very handy solution, which can give results within a few minutes. So I think those solutions come in handy when you want to assign value to the asset. Again, it's very difficult to build very accurate models for multiple crops. But I must say that a lot of these startups are focusing on a certain set of crops and now reaching 95 to 90% accuracy levels. So that's not bad. On monitoring of asset, I think that's been one of the biggest challenges for a lot of warehousing companies. We have seen a lot of cases in the past where stock got stolen or stock was not there, or there were a lot of malpractices there. How do you build models to monitor the stock in the warehouses? And that's where players like Arya Collateral, Star Agri, Origo, AgriBazaar, Procol, I think they come into play, who are trying to digitize the post-harvest value chain. Of course, some of them also do collateral management, but I think most of them have migrated to building digital models which can help in monitoring and which can also give comfort to bankers on the entire traceability of the process, right from arrival of goods to quality assaying to issuing of receipts to monitoring of assets and all the way to liquidation of assets. So I think that's what we are seeing on the post-harvest side. It's still a lot to do. The post-harvest finance or the warehouse receipt finance is only $5 to $10 billion in India, which is drop in the ocean, or value of crop assets harvested every year is in excess of $250 to $300 billion. So a lot to do on that side. And again, I see the role of these startups. Last but not the least, ancillary industries. And again, it's early days, but all I can say, in each of the ancillary activity which farmer does, be it dairy, fishery, poultry, aqua, and sericulture, there are multiple startups who are mushrooming and who's trying to, again, the whole model is digitization and linking these sort of linking farmers on the input side, linking farmers on the output side with a lot of end-to-end traceability. And I'm sure bankers can draw a lot of comfort when you see a full supply chain, and these startups can act as a catalyst for loans which can go to the farmers. So this is a summary of what I've said. I've tried to map the various stages of the crop loans and the post-harvest loan and try to map it with the type of startup which exists in the ecosystem. I think two big learnings for all of us here. Unlike urban fintech, which has got polarized towards digital models, the rural fintech is going to be digital and physical. So we have to have a hybrid approach if you want to scale it. And I've tried to map, what components of the processes are digital, what are physical, and what is combination of digital and physical. So I think that's going to stay. So that's number one. Number two, which is also very clear, that no one single startup can solve all the problems, right? So if you are a bank, if you are an NBFC, I think a collaborative approach of working with multiple startups together can potentially solve the problem. So all the banks and NBFCs who are on the call, I'll urge them to look at a cohort approach, not just one startup. I don't think we have reached that stage. Maybe 5 years from now, you never know. But as of now, it has to be collaborative. And I must say on this call that I've seen multiple ecosystem, but agri-tech ecosystem is much more collaborative than many other ecosystems. So it's not a big challenge to bring these guys together. So I think these are two key learnings for me. Last slide, policy prescription for the government and the policymakers to essentially scale institutional credit. And I think I put down some points. I'm sure there are many more, but I clearly building an agri stack for farmer onboarding is critical to take this solution to the masses. An agri stack is nothing but building identity of the farm and linking it to the farmer who's flowing on it, right? Because that solves the challenge of the first mile and the last mile, that also solve the challenges of validation and authentication of a lot of information. And all said and done, the government has to develop it and own it. But all I can say, a lot of agri-tech startups are well placed to do pilots so that we build up an agri stack at a pan-India level. A digitization of agri input sale could be another thing. I think that is extremely critical in linking credit to the input sales, which can make sure that that the credit is being productively used. And also it can also help us in doing demand forecasting. I think every year we run into challenge of supply demand imbalances. If you digitize the agri input sale, there's a good chance you can estimate what product will be harvested at what time and what quantity, which can solve a lot of policy challenges that we face year on year. We also need a marketplace which can convert crop loans to post-harvest loans. I think that is so important. We don't have a mechanism at scale. Some of people have tried it, but I think we need to probably build more institutional mechanism which can make this process more transparent and smooth for bankers and NBFCs. ENAM, we all know government is very bullish on ENAM. There are 1,000 mandis which are on the ENAM platform. There are 170 commodities which are traded on ENAM. It can be a platform where bankers can source leads for giving loans, and this platform can also be used for settlement of loans. So I think there is a need for getting bankers on the ENAM platform so that some of the value chain financing can be accelerated. E-repositories is critical. Challenges with physical resources. They are fudged. They get mutilated, and that opens gates for a lot of malpractices. So building platforms like NERL is critical to boost post-harvest finance. Climate-linked financing. I think this is one of the areas of interest to me personally. I think this is high time we should think about it. We incentivize farmers to pay on time under PSL lending. Why don't we incentivize farmers to use water efficiently, to use fertilizers efficiently, to use pesticides more efficiently? Why don't we incentivize them to reduce CO2 and GHG emissions? I think climate-linked financing can play that role. We are doing certain pilots, and some of the players on the call are part of that pilot. I think it will be interesting to develop models around climate finance. Last but not the least, a debatable topic of loan waiver. I think there are situations when farmer genuinely deserves a loan waiver, when there's a lot of stress. But how do we create a framework for it? I think that is important. Fortunately, we have a lot of data available now, thanks to these startups who can capture data and who can build models on farm stress, whether it is stress because of weather, because of flooding, because of crashing of prices, because of demand supply imbalances. I don't think it's a big deal to develop that framework and then use that framework to objectively decide when, where, how much loan waiver can be given. I think that can take a lot of politics out of the equation. So I think those are some of the suggestions that I have, Arindam. That's it from me, and thank you very much for patient listening. Over to you, Arindam. Thank you.
Thanks, Amendra, for the wonderful presentation and for setting the context. Now I will jump directly into the panel discussion. Now, one of the very exciting characteristics of the Indian AgTech FinTech development is the kind of human resources which has got into problem solving. The best in class talent is there. And the first, I would like to invite Arjun Ahluwalia, one of the brightest talent getting into India to solve the access to finance issue. Arjun, the first question to you. Now, we would like to learn a little bit about Jai Kisan's business model. And can we also let us know as to what are the key challenges you've faced, and you have already done a few pilots as to how scalable the entire model is. And before Arjun, you start, I think we have a poll question. The organizers can put up the questions, please. I think we'll struggle a little bit on time, but Arjun, I would request you to carry on with your comments, please.
Thank you so much, Arindam, for the very, very kind introduction. Very much appreciate your support, your guidance and insights that you've delivered to us over the course as we build Jai Kisan to where it is today. Thank you so much for also hosting this panel, Hemendra, Arindam and the Access team for bringing us all together, and really looking forward to a super engaging conversation over the course of the next 1 hour. Arindam, you've obviously asked us a big ask here to be able to kind of outlay our business model in front of a large audience. So I think what I will try to do is explain the broad level details about how we are trying to make it scalable and what kind of businesses are able to scale to that effect. At the same time, I will explain our business model in an easy way so that everyone, irrespective of what kind of backgrounds they come from, are able to get some sort of takeaway. So ladies and gentlemen, what we largely focus on the demand side is to be able to digitally and financially include the rural Indian and to help them build a footprint online. Leveraging this particular footprint, we are able to bring a full suite of financial services to these customers, starting with credit, going up to payments, and then taking it to insurance. That is where we've reached today. Very shortly, we will also be operationalizing savings products for these customers that we are able to digitally and financially include. On the supply side, we work very, very closely with financial institutions. Today, we work with banks in India, we work with NBFCs in the country, and we've also now started working with development financial institutions as their fintech partner or as their business banking correspondent, helping them customize financial products at an extremely small ticket size for these customers who are extremely different, as Amendra has pointed out over the course of the past 10 minutes, compared to an urban Indian story, right? And helping them manage the process all the way from onboarding up till collections and everything in the middle. But that is when the journey really starts, is after you collect, because that is when you're able to actually harness that data of that one particular loan cycle and then give some other financial services to this customer. It can be helping them secure that livelihood that you've helped increase through credit by providing an insurance product when that particular livelihood has fundamentally increased, by providing digital payments products so that these guys and girls can make significantly more digital and efficient payments across networks and across transactions, thereby helping them reconcile, thereby being able to help them also leverage all the sort of transactional data that they are creating and building a footprint with. And finally, what I want to touch upon over a 1-2 minute is, why doesn't a large financial institution today go and onboard or digitally acquire these customers? There are two large points. That's what we believe internally here at Jai Kisan. Number one, there's an extremely high cost of acquisition, which we've heard over the course of this panel before as well. But if it was just a high cost of acquisition, a bank should probably stop acquiring customers on Park Avenue or in Malabar Hill in Mumbai as well, right? But they do. And the reason why they continue to do that, whereas they don't for farmers or rural Indians, is because the lifetime value of that particular customer in rural India is very undefined, because their ITRs don't call out anything regarding to their incoming cash flow, right? And they do not have any sort of digital and financial footprint. And thereby, any sort of model who is looking to become scalable in facilitating financial services needs to ensure two things. Number one is an extremely low customer acquisition cost to acquire the customer, which has been done fantastically and executed very well in urban India. So it is to be able to pull learnings from that and dwell them while making sure that we are able to tweak them for the rural Indian story. And in addition to that, to be able to capture large sets of data and generate insights on them, to be able to action upon them in the future with upselling or cross-selling financial services to these particular customers. We originate these data sets or these customers from two sorts of partnership models. We are a B2B2C platform, and that is how we are able to reduce our cost of acquisition as well. Arindam, going back to your question, what were some of the learnings during this period, right? One was that, a startup or NBFC or whatever the case may be, acquiring each customer at the farm gate is extremely hard, right? And a very, very expensive proposition. Whereas we very clearly, humbly acknowledge that there are solid platform partners on one side working very closely with farmers. These can be e-commerce input sellers, these can be e-commerce equipment sellers, or these can also be procurers of output from these particular farmers, many of which are speaking today and many of which were listed out by Hemendra previously. With these, we work in a manner to be able to integrate with their platforms and provide checkout financing for whatever the farmer is purchasing. And on the other hand, provide invoice financing for the farmer to be able to sell that produce to that off-taker. In the process, we are now able to capture a significant amount of data around the customer and digitally and financially include them into the ecosystem to give them access to other financial services in the future. But as Hemendra also pointed out, we very clearly figured out the urban and rural story is very different. And the rural story is less than 1% commerce is traded through digital marketplaces. 99% is still happening through Ramlal Ki Dukaan. Right? And how do we get Ramlal Ki Dukaan, which is this particular agri input seller on ground, or the FPO which is procuring from the farmer in district headquarters or whatever the case may be, online? Right? So one is that, that's how we started off, and I know you know this very, very well, is by being able to provide some sort of onboarding solution at their point of sale or point of buy to be able to digitally and financially onboard that customer. How do we scale this out to be able to actually cater to every single rural Indian? Is by being able to digitize those transactions in the middle. Right? So over the course of the past 1 year, we've significantly worked at being able to digitizing the transaction between the farmer and the seller or the off-taker. And now as we digitize those through a digital ledger, a smart business assistant tool, we are able to provide checkout financing at Ramlal Ki Dukaan as well. And that is how we hope to be able to fundamentally scale this model up while also building a solid and sustainable business model to be able to create that particular impact at a very, very deep-rooted level with farmers and rural Indians at large. So I think I'll try to stop there, Arindam, and can jump into any specific questions that you may have on that.
Yeah, thanks. Thanks, Arjun. Very comprehensive, and thanks for introducing us to Ramlal Ki Dukaan, ubiquitous all over the country. And with that, I would like to go over to Devlina. Devlina, now you have a technology solution for inclusive, efficient, sustainable supply chain for the fisheries sector. Now, so far as fisher folks are concerned, access to finance remains a big, big challenge. What is your business doing, leveraging technology to enable financing for fisher folks in India?
Okay, yeah, thank you, Arindam. And first of all, thanks to the entire Access India team, Rabobank, for this wonderful opportunity to speak. Just a quick introduction of what we do. At Numerate, a product which is currently working towards sustainable, traceable, and profitable fisheries, and we work across the supply chain, which helps us in enabling, to get data starting from the point of having providing them fishing zone advisories to the point they're selling the fish to the end buyers. And with this data being collected, we are providing them, they're giving them being able to catch fish at a lower cost, being able to sell directly on a marketplace, able to recover money at a faster timeline, and down the line access to finance and insurance. I think I'm the only one here from the fisheries sector, so I'll speak a little bit about the sector and then talk about the fisherwoman in perspective. India is a second largest fish producer in the world after China, and we contribute to almost 6% of global fish production. So the sector has big economic contribution. But even given that, if I really have to compare apples to oranges, fishing versus farming in the agri sector, fishing has not seen too much of application of innovation or even application of reforms, policy reforms to the grassroots level. Some work has been done in the aqua farm industry, but again, we are just mostly dealing with shrimps there, so a lot must to be done there as well. Now, coming to the risks that we address in the space or what we identify, there are financial risks that they face, or the financial institutions kind of identify them as having financial risk, as having business risk, as having resource risk. Financial risks are the typical 5 C's that we see: capacity, capital, collateral, conditions, character. Business risks, range between environment, having the right market, country policies, connectivity, supply chain. Then you have the resource-based risks like having the stock, habitat, natural disasters, data. So when we started, understanding or studying this sector, we kind of addressed, kind of laid down all this risks, and we said, okay, where we can start with, and which one really plagues and which can be addressed with the kind of work that we do, the kind of communication that we do, the kind of data that we collect. And now coming to fisherwoman perspective, there are around 54 million active fishers in the country, out of which 38 lakhs are fishermen and 16 odd lakhs are fisherwomen, which is around 42% of the workforce. And these are all across the supply chain. But when you focus on the post processing or after the fish reaches the shore, it is almost 72% of women-led contribution. But the financial inclusion of women is further less. I mean, financial inclusion of men or fisher folks in the societies around, there's a credit gap of 67 odd percentage. Fishermen is much higher. And when you talk about the problems that we typically see is they range from having social issues where they have lack of representation in the fishing cooperatives. We have visited societies which has 1,000 odd fishing members, but fisherwomen are only tens or 15 in the entire 1,000 member board. Then there is economic issues which are like having poor working capital, having poor income or very low pay standards. Institutional issues like lack of access to credit, lack of post harvesting facilities, like technological issues and not having training opportunities, even access to training opportunities, and various other ergonomic issues like low literacy rates and even awareness of the marketing standards. And where we start working here is basically, since we work at the grassroots level and since we work with the small and medium scale fishermen, we also do a lot of work with the institution or the industry level fishermen, but mostly our work happens with the low and medium scale. We try to provide these facilities through our various other partners. We are a small startup, but we're integrated with various marine biologists, various suppliers, various societies, and through which we try to do such intervention which gives them the access to the knowledge that is required to really broaden their market scope. And we have been having certain talks with the financial institution as well, where typically what Hemendra sir pointed out is the same kind of issues that are faced with the financial institutions, which leads to the credit gap, right? So it leads to difficulty having onboarding this fisherwoman, difficulty of identifying having the credit worthiness of the fisherwoman, difficulty being to reach out to them, estimation of the kind of yield that their societies or their location provides them, estimation of market access, and difficult to find guarantors for the loan. They are not members of any established society, so difficult to find guarantors is something that is highly challenging. And of course, monitoring, assessment, and valuation of stocks that even Hemendra has talked about. So the kind that so what we started understanding at the very initial stages of our work is that being able to really map the supply chain end to end and being able to gather this data which is needed by the financial institutions to really assess the credit worthiness. And we have modeled it in a way where based on some success stories we have seen, and there are a couple of success stories. There are Dhan Foundation doing excellent work in southern India. There are various such self-help groups, various such joint liability groups that has worked primarily with fisherwomen and seen a lot of success stories. In fact, the recovery rate from the fisherwomen is 25% higher than fishermen. So, and we have kind of studied their models, understood what kind of data these institutions need to be able to credit value this fisherwoman, and being able to really channel or connect, provide them operational loans at a rate that is acceptable for them, and which is much lesser than what they're getting from their money lenders in the market. So, and of course, this is not just initial assessment. This goes throughout the life cycle of the loan, right? It starts from assessing, starts from throughout the life cycle, how the loan is being utilized, where are they putting the loan money to, what kind of fishing inputs are being, bought from that loan to the completion to the recovery and completion. And this end-to-end, monitoring is what we provide. And I believe we are working with certain financial institutions and believe we'll be able to, work with furthermore, and, forums like this will definitely drive this message to furthermore such microfinances.
Thank you. Thank you very much. With that, I would like to move over to Pratik. Pratik, very exciting journey of Satchio, and you have been one of the pioneers to unlock capital or to increase capital flow to smallholder farmers and to the farm sector. Could you give us a brief overview of the Satchio model and how it catalyzes and farm financing for the farmers in India, please?
Thank you, Arindam sir, and good afternoon to everyone. Sorry that you are seeing a lot of disturbances behind me. I'm taking this call from an airport. So just to give a background of what Satchio does, we are a technology platform that helps make the flow of data coming from different places smooth and then converts that data into information, and that information into action. Now, this may sound a lot of jargon, but I essentially need to walk you guys through how banks use it. So in India, we are working with the two top largest private sector banks in the agriculture sector as of today, and right from the time of when you are strategizing your retail lending, the KCC product lending strategy from branch level to the time you are planning your collections, everywhere we play a role. Now the problem is many of the companies today are still figuring out what do you do with the data, how do you push that data, because there is a lot of friction within the banks, friction in terms of adoption, friction in terms of extracting the value from this data. So let's taking the example of what Hemendra sir presented earlier, that farmers need the history, farmers history of the land and the region is an essential activity for the customer onboarding. However, that information has to be in the form of in a very consumable form, meaning what are the different parameters that are actually required. Is it related to the soil, is it related to the water, the yield, how much does each factor impact the actual credit behavior. So all of these things requires a lot of data crunching, a lot of testing with actual financial data, which the banks are not willing to share. Which means that one cannot just push a SaaS product onto them where you are acting like a data brokerage platform. That is where we come in as a complete end-to-end analytics platform where you can combine financial data with all the alternative data sets that we are working on. The primary input of that being satellite images, because the scale at which you can do this work ranges from a sub-acre farm to the entire country. So when you marry this scale with the financial data that banks are sitting on, that is when you get the magic, and that's what we are enabling at SatSure, which has helped today increase the portfolio size of both the banks that you are working with here in India, as well as we have been in one of the instrumental platforms basis which collections efficiency has improved. Why? Because we are able to prioritize them to do targeted collections to capture their delinquency rates. For example, we are able to tell them that when and where the harvest is going to happen, at what time, what is the harvest, is the crop quality good, what would be the impact on portfolio quality. So these are the kind of things which we do at SatSure, and we start linking our KPIs with our clients, staff KPIs, and that's very important. Like why would in the organization they have to undergo this process change when you start actually taking actions on the data. So by linking linking the KPIs of field staff, relationship managers, the debt managers with the data that both it coming from the headquarters as well as the bottoms of feedback that is coming from the staff at different branches, by having this bi-directional flow of data, we are essentially changing the turnaround times for the banks. We are changing the cost of servicing and cost of acquisitions of the banks by as big as factors of more than 30%. And that is where we at SatSure play. And our experience with banks have been, I would say, mixed. I mean, you can be the biggest bank of India, but you still, need to have a lot many more things in your system beyond the will to actually observe something like this, because uh, the friction within internally within a bank, once the strategy has been set, like okay, this product actually delivers value, so how do we make this seamless, that requires the IT team, the product team, so many multiple teams who are servicing again many more internal teams there. So I would say that this has been a learning journey for us, where even our product had to evolve to capture some of those gaps, internal IT gaps, while the banks thankfully have done the rest. So all in all, I would say I hope I could give a good picture of what we do at SatSure. and also a little bit on the experience that we have had with banks. And this is not just banks, it's also insurance companies, which is our another primary clientele.
Thank you, Pradeep. I'll come back to you with a follow-up question later. And now over to Raul. Raul, you oversee rural lending, agribusiness lending for one of India's largest financial institutions, a bank, a full-fledged bank. Now, Raul, now you've heard a few of these new age technology companies trying different kind of innovative solutions to help unlock capital from mainstream financial like yours. Now, could you tell us as to how you look at this very exciting development? What's your view of all the different kind of discussions and exposure you have had to such fintech and agtech platforms? Your view as a very senior banker in the sector.
Yeah, thank you, Arindam. I hope I'm audible.
You are.
Can you hear me? Yeah, thank you.
Yes, please.
Yeah, so thank you, Arindam. Thank you, Access for having me again here on the annual on this annual platform. So I'm kind of reminded being here of this constant accusation that we get that bankers are the most boring breed. When I had the access to see Hemendra's PAPAC presentation, I think and specifically being boring, as an agriculture lender for so many years, I think we have approached this lending in a very unimaginative manner, right? As in decades ago, we would still use the same approach of consuming DLTC, classifying crops basis of cereals, pulses, etc., putting a multiple, using some credit score, and finally lending a certain amount per acre, and then hoping that there would be no debt waiver so that your loan gets recovered. So we've actually done nothing imaginative in this sector for long. So the least we can do now is to be a beneficiary of all these innovations which are happening around us, and plug in these innovations, these great minds which are here on the platform itself, and use these tools to up our game. Because this is not a small sector. If you look at the retail lending, portfolios, agri loans, crop loans is just under mortgages. It's that big, and it is something which most banks today are looking at, to optimize on, looking at to grow, because it gives you very healthy returns. So now let me transition into my experience, and I'll draw from Hemendra's classification of agtech companies. So what we've done pretty early on, and you've heard Pradeep also speak about it, about 3 years ago, we've evaluated these the agtech companies who were on the precision agtech, right? Because when they pitched to us the solutions, it seemed like something really interesting. So the last for 2 years, we've tested their models. We've tested what the claims they had on what the satellite imagery could do to one split risk, and how it could also help us in sourcing. And I would say that when we did the testing across the country, we found and we got very good results. So we already employ precision agtech, and as Pradeep also mentioned, most of the leading private sector banks are employing these tools today. What it does is for a banker like me who's looking at constantly increasing our book. Before these tools were available, we would just have to look at credit outflow as a proxy for setting up distribution. We would look at our past experience in a certain location. We would look at the normal risk tools of credit bureau scores. But these additional tools which we get in terms of crop yield, density, crop health, all this also adds up into our ability to firm up our existing scorecards, add an additional layer, and then put more feet on street where the opportunity, as predicted by these tools, help us to to make these decisions. Number two is on the credit underwriting. So we have in fact already using the tools on the credit underwriting side, specifically because the kind of enablers are not just at a block level or at a village level. They actually predict, and they're able to give you insights at a very at a plot level. So in terms of underwriting, these tools work well, and we've tested them, and we're starting to now use them in a more prolific way. I think Pradeep also mentioned that it's not just business, it's not just underwriting, but collections, which is at the heart of agri lending today. Collections is we've seen the credit cost shoot up. It's become a matter of great concern. And when you're able to give bankers the confidence that they can track the progress of the loans they've given across the life cycle of the loan, I think it's a great tool to have. So precision AgTech, definitely for most banks, it's something that is proven. It's something which and most players who Hemendra mentioned, I'm sure are tied up to some bank or the other by now, by virtue of the upsides they've proven. Now coming to to the ag fintechs and my experience and our experience on this side, it's been early days, but we've tied up with a couple of players. Where we've been more bullish on is where we've been able to co-create scorecards with some of these players. It just gives us more visibility on at least it gives us more confidence, because we know that whatever is being underwritten has elements of what we would like to see in what we are underwriting. I would say early days, but I heard the earlier speaker talk about the cost of acquisition. It does solve for that, because the ability for tying up with these players and the tools they use to reduce cost of acquisition is significant. So ability for banks to tie up with ag fintechs, and you have the best ones over here on your panel. So I think that's something which we would definitely endorse. And finally, on the third part, which is on the post-harvest ag tech companies, we've not had the privilege of tying up with anyone so far. Indirectly, we have worked with them through our end-to-end tie-ups on the agri value chain with some players. So we do associate with them indirectly, but I'm looking at Hemendra's data points. I do think that's something which can definitely be worked upon. So I'll pause here, Anindam, and if there are any questions or if there's any follow-up questions you have for me.
Thanks, Raul. And what you said would be very, very exciting for not only the other panelists that we have, but also for the entire sector, that the banks are actively looking at working very closely with agtech companies and ag fintech platforms. Thanks for that, Raul. And now we move over to Anil. Anil, you have set up Samunati. Now, Samunati started off as a traditional NBFC to provide solutions to supply chain financing in the ag sector. And over a period of time, you have adopted technology. You're working with a lot of agtech, ag fintech players, an exciting journey. And now you are the front runner so far as innovative solutions in the agriculture sector in India is concerned. So, Anil, your view, your expert view on the developments in the agtech, ag fintech sector in India, please.
Thank you, Arindam. It's again a great pleasure to be in the midst of wonderful friends and wonderful people doing a lot in agriculture. For some of us, Inclusive Finance India Conference was a platform to reconnect for very many years. Arindam, Raul, it used to be annual pilgrimage. This year it is virtual. Hope to meet in person next year. But then, we also have to adapt. So Arindam, going back to your question, let me bring the perspective of why Samunati exists as an organization and how we look at it. Samunati's purpose of existence is to make markets work for smallholder farmers. That is the purpose that has been constant. What has been evolving is how to make it happen and what are the tools that are required to take us closer to making markets work for smallholder farmers. From that constant lens, representing the farmer's perspective, when I look at technology as a dimension, there are two categories that emerge in my head, in my perspective. One category is the category of the providers, the agtech companies, the entities that provide services. And the second dimension is the recipients of these technology services, the beneficiaries. When I take a look at the providers of the agtech companies or the providers of these services, the technology providers, there are again two categories. One, the startups that are coming out with very niche and innovative solutions that can transform a particular part of the process of agriculture, whether it is cultivation, whether it is monitoring, whether it is processing, whether it is quality testing, plethora of services, but very many interesting entities are coming up solving one or a group of these these challenges or these dimensions of agriculture. We also have a lot of entities that are in the agriculture space, not startups, but are looking at innovative channels, innovative means of reaching out to a smallholder farmer through a technological channels than their conventional dealer, distributor, retailer channel. So when we look at the provider's perspective, there are host of new entities that are coming up. There are also host of entities that are coming up in looking at innovative means of reaching out to the same smallholder farmer. So being an ecosystem player in agriculture to make markets work for the smallholder farmers, what we are looking at doing is engage with the startups in a different way, and that is where the platform for agri startups called Samaram comes into picture. And I am certainly a great believer in what Hemendra mentioned, the collaborative approach, because gone are the days where we consider each other competition, and in agriculture not at all, because unless we work together, it's very difficult to provide a comprehensive solution. And Samaram for us is an answer to that, wherein we engage with the startups in making them excel in that niche area that they are looking at building their expertise, while bringing the smallholder farmer through the FPO to be able to engage or try out the particular service that is there. And this Samaram platform went live on 15th of August, as some of you would know. And we have about 150 genuine applications that have, the startups that have made their entry into Samaram, and about 72 of them require customized working capital solutions. Only 12 of them have asked for advisory services in terms of, hey, can you tell me how I can do this service better? And about 50 of them have applied for, can you provide me access to your FPOs and in turn to your smallholder farmers so that I would be able to deploy the tool that I have. So the way we are looking at engaging with the agri startups and agtech companies who are finding their feet in making their services available, making the access to their services possible through customized working capital solutions, which is what Samunnati has the core expertise in. The other large entities, which also include large input manufacturers and agri equipment manufacturers, they are looking at making their services be known to a large set of farmers. And is there an inorganic channel that can be built to make these services directly accessible to these farmers? And one of our efforts in making this information dissemination happen is through the Agri Elevate, wherein the endeavor is we build what we refer to as a Pragati Maidan for the agri providers, which would of course could also include the agri startups and startups in the agri space which don't have technology. But the idea is bring in all kinds of players, and with FPOs and farmers being the visitors to this virtual directory or the virtual platform. Now, the second category of the technology dimension from the farmer's perspective is the beneficiaries, the recipients. Who are these people who are being focused on, and the fundamental question of who pays for the service. And that is where a lot of structuring and a lot of insight needs to be had by the startups, I would advise. Because the moment we say farmer will have to provide for the service, I often mention this in these panel discussions. Unless the farmer has the the delta in the income immediately available, the tangible benefit of using this service, paving way to earning another 100 rupees, the farmer would not be able to pay for this service. Now, if the farmer indeed is the beneficiary, then who should pay for the service? The second set of recipients or beneficiaries are the farmer aggregators, are entities like us who need a set of farmers to be able to engage with the farmers. And what are the services that would be possible in order to access these in a risk-free or less risk structure? And that is where entities like Crop in Satsure would play a significant role, because they are not solving the customer's problem. They are not solving the farmer's problem. They are solving the problem of Rahul, myself, perhaps Arjun. What they are doing is they are providing us the ability to monitor, ability to look at the end use and make a fair, fair assumption that what is happening on the piece of land for which the money has been given. How do we provide the risk mitigation is what these entities are working on, and how do we utilize the risk mitigation? One, to reduce the risk, the credit cost that Raul mentioned, or how do I proliferate access to these markets? And it also includes the insurance companies. And last but not the least, there are certain that are required to be able to create new markets. Where again, taking a cue from Hemendra's policy level recommendations in the last slide, the futures market, the ENWR, the NERL, so on and so forth. Each of these can open a new market, and the moment NERL and ENWR together come in, you are basically dematerializing the material commodity. And it takes away a huge inefficiency in the logistics, because now the commodity need not travel back and forth or from one location to other location. It travels once, and then after that it is digitized. Right? We see a lot of that to be the potential gold mines that we are all sitting on, and a collaborative approach in technology will hasten the mining of this gold mine, or else it will be a mechanized gold. Each of us trying to find that pot of gold, and we don't know. Finally, the gold will remain, and who will survive.
Thanks, Anil. Wonderful to hear about the work that you and Samunati are doing. It's not only financing solution, but also gradually, incrementally improving the sector, looking for new solutions, new innovations to address this large challenge. Thank you so much. Now we move over to the second round of questions, and due to the time constraint, I would request all of you to give a 2-minute answer. Bullet point answers, please. The first question to Arjun. Now, Arjun, with the platform and the kind of work you do, now in future, would you like to set up your own financial institution or continue to leverage capital from mainstream bank? And what are the pros and cons of each, please? Arjun, over to you. 2 minutes, please.
Yes, we'll try to keep this short and sweet, but this is a question that probably keeps every fintech entrepreneur awake at night, right? It's to be able to solve the supply problem. Now, we were blessed to be able to, get formed in the late, half of this fintech innovation kind of coming up, right? There were already set in stone players in urban India who had created platforms by leveraging their own balance sheets and being able to show to banks that a fintech partner banking correspondent model works. So we did start initially with partnering with financial institutions and facilitating financing as their business banking correspondent or their fintech partner to our farmer customers or rural Indians. This fundamentally is called on lending, right? The advantages for this or of this are that the risk that a platform takes is lower than doing from your own balance sheet, because there's risk sharing between the platform and the lender partner. Right? There can be significant supply side scale that can be achieved with this, because you can partner with multiple financial institutions like we do today, right? And very quickly, within 1 year of kind of partnering, you get access to significant lines without going through the process of credit ratings and things like that, which is the more traditional way to be able to pick this up. Because again, that debt doesn't sit on your books, you're just facilitating this through your platform to the customer, right? Now, I think one of the biggest fundamental challenges here, right, is the slow operationalization of this, right? One, obviously, bankers are extremely busy people and very, very hard to convince and kind of get over the fence when, they've not believed in a particular asset previously. But what we see is that, fintechs in urban India have actually created significant changes at the customer level. Today, I don't make payments through cash, right? Even if it's to a rickshawala. In Bangalore, our startup friends actually do 95% of their transactions, digitally. So to be able to fundamentally enable that, that would be one. Number two would be able to enable cheaper rates, right? So while priority sector lending exists, right, somehow when banks get into a fintech relationship, that PSL does not get translated in these numbers here. Okay, only after you kind of mature with them do they kind of lower, which we've seen with the case with us as well. So yes, track record does benefit a relationship with financial institutions. And finally is integration and customization of products takes a long time, right? Because obviously, integrating with these huge, secure, robust tech stacks of banks takes a while, number one. And then to be able to launch a new product or customize a new product takes longer. By that time, your demand side may actually already get catered to. Okay. On the other hand, with respect to on-book, the advantages obviously are the full control on operationalization of any product, right? Which obviously, Anil as Samunati is blessed with, and he's able to roll out products significantly quicker in that manner because they have control over their own use of funds as a fundamental financial institution, right? The other side is that you're able to achieve both demand side and supply side scale if you are able to raise the right amount of equity, because debt will only be levered onto your own equity, right? And lastly, and most importantly, is cheaper costs and access to large global international organizations and DFIs, much like yourself, Arindo, right? Because you do need, at the end of the day, a sort of vehicle which can process and loans in a regulated fashion in this particular country when you're picking up debt from these kind of institutions, right? To be able to get more innovative sort of products to the market sooner. So to answer your question in one line as to how we think about it in Jai Kisan, right? It is, one hand, one take kind of approach where we are going to dwell both, right? The on-lending is for the more mature products with our matured relationships, which brings us significant scale and size on the supply side. Whereas our own, balance sheet or us using our own capital or being able to take on debt and levering that up, right, would be to be able to incubate more aggressive and innovative products to get to that, small customer, which a bank is still getting used to, build that track record and then get it up to a bank. Stop that.
Thanks, Arjun. Very comprehensive and very, very interesting. With that, I move to Devlina. Devlina, now, can you tell us a little bit about how your business can facilitate sustainability and green financing in the fisheries sector? 2 minutes, please. You're on mute, Devlina, and this is a point that Hemendra touched on, sustainability financing.
Sure.
Yeah, 2 minutes, please.
Quickly, in the interest of time, basically, I'm the only one from the fishery sector, so I'll quickly explain what is sustainability in fishing. Sustainability in fishing is using the right mesh size or the net size where you're not catching juvenile fish. It's not catching out of season fish. It's using the right fishing gears. It's not using illegal or overfishing methods of fishing. It's making sure that you're not overfishing a certain types of fish as well. So all of these what you're trying to do is basically incentivize fishermen or fisherwomen who are making sure that these kinds of practices are not inculcated by them. And this is not just a fisherman problem. This also applies to supply chain at large. Like if big buyers, and which we typically see because big buyers cater to the demand of the society, right? So big buyers, if they are not really, driving the sustainability throughout the supply chain and they're asking for a typical type of fish throughout the year, that creates unsustainable fishing. So it's it's both sides of the supply chain. What we do is making sure that the data is available again, because if the kind of traceability that we apply to a supply chain and gives the end consumer or even the one who is buying fish from us complete transparency of where the fish has come from, who has fished it, what is the fishing gear, what is the fish category. So all of that is enables to really understand which sector, which part of the country or which port and harbor is inculcating or having these practices, where a certain kind of education can be given, because some of them don't really realize doing it, right? And we already spoke that we work with marine biologists, we work with societies where such kind of dialogues can be extended to. So this is again something that we have been doing with our traceability code, with our various other people that we work with, home chefs, hotel chains, retailers that we work with also kind of helps us spread the word, because unless the demand stop, the supply won't stop, and also making sure that incentivizing of the fishermen happens. Encouraging them to not catch a typical type of fish or catch out of season fish, or use a typical type of net, sustainable nets for that matter, and making sure that end-to-end thing is happening. In the broader level, in the entire globally, we see MSC, we see various such sovereign bonds like a blue bond or a green bond, but we don't see such application in India yet. We are hearing some good news from SBI having a new green loan after recently they have taken up. I believe that can be applied to a fishing sector. As of today, we provide them certification, we provide them whatever incentive we can provide through supply chain, but we hoping big institutions, corporates can help us really take this dialogue a little bit further into a bigger national policy or regional policy.
Thank you. Thank you, Devlina. With that, I move to Prateek. Prateek, there's some disturbance coming from your side, but quickly in 2 minutes, there are banks and there are banks. What's your experience? You did touch upon that in your previous, comment, but what's the key message you'll give to the new entrepreneurs today, the new agtech companies, on how to deal with large established financial institutions? You're on mute, Prateek.
Thank you, Arindam. So that's a very interesting question. See, there are multiple reasons why one can fail, with a bank company, companies like ours. It can be the first and foremost thing is identify your champions, internal champions properly, because large banks, they are like an ocean. You have so many people, and you need to understand who is your champion. The user is the champion. The guy who is going to pay for it, and that's very important. And I'm putting this above the value proposition definition. And the reason is that you know uh, the ability to understand what will work and what may not work for the large bank only lies with the top management. Unfortunately, one can't start at the middle management and then scale within a bank across its portfolio and create make sure that the value that is promised is delivered. So that's something which definitely would be very much to look out for. Another aspect is consistent interaction with your clients, with the users. When I say clients, a client is a guy who pays, but then you have multiple sets of users, and even within this large organization, sometimes the bottoms of feedback doesn't come because of multiple reasons. So we always made it a point to call up the guys who are using our mobile app the most, who the guys who are asking the maximum number of troubleshooting, and also with the heads, etc. So yeah, given that, I believe both of these aspects, one is the the thing about interacting continuously with client, because it feeds into your product development, it feeds into what exact value are you delivering at different levels, and the other part being identifying the right kind of people would be the two most important things I would say works. I hope this gives a good picture, sir.
Thanks, Pradeep. And now over to Rahul. Rahul, now you heard from Arjun about the quandary of when to use their own capital or when to leverage capital from the mainstream bank. Now, from your side, as a full-fledged all-service bank, now would you prefer to co-create a technology platform with one of the external players, or would you prefer a full stack solution being provided to you by a third party? What would be the preference for a large bank like yours when it comes to agriculture financing?
Yeah, so Anil, I have a bit of I have a bit of a biased answer over here, as in I would be biased towards the first option, having the ability to co-create a finance model with a partner for reasons. One is we have done it in the past. We have seen that we get confidence because we have some amount of control over the variables being employed. We have visibility, most importantly, on what's going on in those credit models. So slight bias there. Having said that, not averse to looking at deploying capital in a in an entity of full stack external platform on a couple of conditions. Definitely, one is that platform should have demonstrated over a period of time credible lending. Number two, that platform should be able to put skin in the game, and if they are able to do that, I'm sure that evaluating such platforms wouldn't be something that anybody would be averse to. But yeah, again, kind of alluding to what the preference would be, definitely co-creating a finance model.
Thanks, Rao. Now over to Anil. Anil, you have seen a lot of developments in the last few years in Indian agriculture. Now, can you in 2 minutes tell us about the 2-3 big trends that you're seeing, which could potentially change the game so far as agriculture financing in India is concerned? 2 minutes, please. Anil, you're on mute.
Yeah. No, we are disciplined panelists. We go to mute immediately after speaking, Arindam. Okay, sorry about that. On the channel front, now we are certainly seeing a lot of traction on FPO being a very, very promising channel to reach out to the farmers. And second, there is also a channel of individuals coming in as agri-entrepreneurs. I certainly would believe that these two channels will pave way to many of the product, services, and technologies reaching the last mile farmer for two reasons. One, there is a nice business model that can be built in both these channels, being incentivized to move these services and access. Two, the adoption of the farmers would be much better when the channel is available closer to them. So that is one trend that I would certainly bet on. The other two are on the dimensions of how this play out. First one is the integrated approach to the value chains. You take a product and see what inputs are required, what monitoring methodologies are required, and what kind of market linkages are required. And that is a model which can bring in all the players, because now you are moving away from the services and coming together as an integrated ecosystem. And again, we ran a pilot in Khammam with the chili growers last year, which we are hoping to do multiple commodities this time, where one input provider provided the inputs. There is a monitoring agency that provided both the satellite imagery as well as the monitoring, and there was the market linkage that came from a corporate. From the farmer side, they were doing what they are good at, which is farming. So can we see more of these integrated approaches is the second dimension. Last is a little aspirational, but certainly have faith that this will manifest sooner than later, is where the post-harvest storage as an Uberization. Each FPO having a small warehouse, physically disaggregated but technologically aggregated. I keep talking about the aggregation on the screen of multiple warehouses, but common quality quantity, and that can bring in a lot in terms of quality testing at the farm gate, price discovery at the farm gate, grading sorting at the farm gate. A lot of services which now are standalone would become necessary as soon as you make the procurement at the farm gate a reality. And that is the other dimension that I would aspire to see sooner than later. So these three are in there.
Thanks, Anil. Wonderful to hear about your views on the potential big innovations that can happen in agriculture financing in India. And with this, it's my pleasure to hand over to Albert Bogard, international expert in fintech, in agtech, to give us his views on what he feels, where he feels India is so far as financing farmers, financing agriculture, leveraging technology is concerned vis-a-vis the developments going on in other parts of the world. What can we learn from others, and what can others learn from us? Over to you, Albert. And after Albert's 10-minute speech, I would request Hemendra to go through the question answers, please. Hemendra, Albert, over to you, please.
Thanks a lot, Arindam, and thanks to all the other panelists for your brilliant introductions and all the challenges and opportunities you describe. In Rabo Foundation, we've been supporting around 40 different ag fintechs in the last 4 years. So we really started in the early days, ranging from companies like Dehaat 5 years ago to other companies that were claiming that blockchain would transform rural communities, or that satellites would predict repayment of farmers. Obviously, we learned a lot of expectations, a lot of hypes going on, and we could even write a book on all the experience, but I'll keep it short. The view on India, from our perspective, is very positive. India has a market size, 126 million smallholders. Also quite important, another 20 million larger farmers, and that's what many other places are lacking. So you have a bit more advanced group that is a bit earlier and eager to adopt. And it's that combination of numbers and density, population density and density of farmers, that creates an opportunity for scale and cost reduction. And probably what happens next is that VC, venture capital, is coming in. And it's probably that what differentiates India from many other parts in the world. So it's the characteristics plus the VC input. Sometimes in Kenya, for instance, at one point, farmers could choose 70 different apps to farm. And why? Because 80% was donor funded, and donor funding has created really confusing environments where you increasingly find it difficult to understand what is real and what is artificial. And I think that's a big advantage of India. It's also the IT talent, the government support from priority sector lending to Aadhaar stack that really puts India apart. And that's also where the opportunities lie to develop new concepts, test them in a relatively stable, well-organized environment compared to other places in the world. Compared to many countries in Africa and even Latin America, India is like a controlled environment where you have a kind of laboratory setting, in spite of all the challenges that you have, that I know very well. Some of the observations, and I'll keep it short. What have we learned in the last 4 or 5 years? One thing I would like to add to the discussions is the diversity. Diversity in solutions combined with diversity in user needs and user priorities. And that creates quite a complex world that really needs a lot of proof of concept and justifies a lot of proof of concepts, even justifies the role of donors like ourselves, Rabo Foundation, or more commercial parts of the bank, but all applied in a smart way. So use donor money where it really makes a difference, and instead of the opposite, where it could disturb. For those who are not daily involved in ag and fintech, I usually say there are two different or two key differentiators to get a first impression of ag fintech, and one is the level of product integration. The level of product integration is very important to understand right from the start. Is it just a sensor? Is it just one satellite signal? Or is it combining different signals? Is it adding other data sources? Is it translating into insights? But still, it could be only related to farm inputs or only to training. And we all know farmers need 5 different problems or 5 different solutions for 5 different problems, at least. And the priorities that farmers have in each region where we work are different. So in some places, finance is the bottleneck. In others, it's knowledge. In others, it's mobile network. And so it's that complex environment that makes it challenging. Another key differentiator that we see is the model of an ag fintech. The earnings model is related to, do they trade on their own account, input, output? Do they benefit from realizing interest margins? Or are they a broker? Or are they a SaaS platform, for instance? And it's very difficult to compare ag fintechs with each other without understanding that key difference, because it all affects the scalability. And what we also find is the user focus. We work with ag fintechs where the founders spend 3-4 months with smallholder farmers before even considering to start. And we have seen others that just have top-down technology development, especially in Africa, and encouraged by donor funding. But we also work with large cooperatives that are probably among the most advanced ag fintechs. And they have integrated everything themselves: finance, input, output, all on a digital platform. And in my opinion, that's still the ideal situation, because we've also seen in this examples, you can have at least, it needs to be physical, as you say, physical and digital. 50% can probably be digital, 50% needs still to be physical. And I believe, and we believe a lot as Rabo Foundation in the power of community organizations. So all the initiatives that we see around FPOs in India, we follow that with a lot of interest, because there's a lot of those transaction costs that you don't want to have as a fintech company. You want to cooperate with local parties. Anyway, the complexity of diverse user needs and diverse solutions. The need for integration, we've heard that already. Some examples have integrated a lot, especially in Africa and Latin America. We find a small number of them, but it's extremely challenging. So cooperation is key. We've done a lot of work on data because we are part of a bank. We look very much at the predictive power and the value of data. And what we learned, we always asked 3 questions. We didn't do that right from the start. But the first is, what is the technical accuracy of a data point, whether it's satellite data or field data collected, because otherwise you get garbage in, garbage out in your credit scoring model. The second one is how much does it contribute or how much does it predict? Because something can be technically correct, but it can only be a very small piece of the big puzzle. And then the third one is when it's technically correct and predictive, is it feasible or is it economically viable? Because the cost can still be very high. That could be cost of collection, it could be cost of obtaining alternative data. And it's that let's say triple question that makes a lot of difference. If you ask me, what are the best data points? Not surprisingly, and it's a bit of an expert judgment, because we only have worked with 45 companies. But I would say financial transaction data is still number one. And that's no surprise if you work from a banking perspective, because historic repayment is the best end resultant of other indicators in the past. So financial transactions, payment data, savings data on wallets, that still makes a lot of sense. I would say the second one, and that's where also the big link with all the AgTech is agricultural transactional data. That is very much underused worldwide. And that's where AgTech really can make a huge difference. The potential to digitize value chains and add real-time data sources, real-time data on transaction, inputs, outputs, quality, coping with climate risks, etc. That's where the real opportunity is. Why is it not so mature as we would have expected? Things didn't go that fast as I expected personally 4 years ago. It's because the digitalization of the farmer environment just takes time. And often with building credit models, we had to start all over again and taking the right definitions, taking the right data points. Data has to be qualitative correct. It has to be joinable. It has to be according to a uniform definition, definition of a farmer, land size. It sounds so simple, but you can easily end up with 20 different definitions, and you have data that is not joinable. So it's the digitalization, making the physical world digital, that just takes time. Fortunately, the momentum is there with increasing internet penetration. And that's basically a process that is happening almost everywhere in the world, where you have the more, let's say, the top end of the smallholder farmers segments. So finally, one final remark, it's digital, it's physical. It will remain physical, but the digital world can really contribute to speed up developments. Blockchain will not transform rural communities. We all know that. And it's a bit of a hype cycle that we were in like 3-4 years ago. But digital tools can really help to transform rural communities and make things more efficient. Reduce transaction costs, reduce the costs of lending. So the potential is there. And one thing I would like to add to that is the willingness to change for traditional organizations. We have found very useful solutions that could reduce transaction costs of a bank with 20-30% in one African example. And then it turned out that the big cooperatives and the banks were simply not interested to change. because it was against their interest, or they were not in for any change at all. And that's why we see also very successful partners in Africa and Latin America. They take on that role as a lender themselves, together with DFIs, with development finance institutions. And they just have explicitly chosen not to be dependent on banks in those cases. So they create completely new business models where you combine an interest margin on loans as an income source with a margin on farm input sales, and in some cases also with a commission on output sales. And then you have a new business model because you have a triple margin that you can use to cover your costs. And building a data science department or a software development department, it remains very expensive. So you need scale and you need numbers. And you need more data, or you need more income sources to cover those costs. So that makes a lot of sense. So that's, yeah. What can India contribute to the world? There's a lot that India can contribute because of all the development and testing that is going on, and also because of the scalability and the potential to develop viable business models. So India has the potential to have viable business models and let's say consistent high quality services that can be connected to other places in the world. Because of the physical and digital combination, it's very difficult to completely transplant an AgTech platform from Bihar or Uttar Pradesh to East Africa. Because that physical component is much harder to scale in other or to replicate in other areas. Farmers are completely different. At the same time, there is a lot of technology and also even concepts like digitalization of FPOs. If you can automate that, if you can digitalize farms, like field boundary detection, crop recognition, small yield prediction models. You can all validate that in India, and a lot of field data is needed for that. So you can all do that in India and easily scale it and replicate it. I get a kind of urgent message from the moderator to conclude. So I will leave it like this. I really enjoyed it so far, and I'm available for questions as well. Thank you.
Thanks, Albert. Thanks for sharing your insights and your deep understanding and appreciation of agri-fintech globally and in particular India. I think that's great. We need supporters like you to take this ecosystem to the next level. And we are out of time, so I doubt we can take any questions. But I want to thank and just want to conclude what Raul said, that we need to be a little bit more imaginative in looking at agriculture financing, and as Anil mentioned and validated, that we need to be a little bit more collaborative, right? So I think with those thoughts, I think I would like to conclude. And I personally believe that next decade is going to be a decade of agri-tech, agri-fintech. And we have the flag bearers on the call to take this mission forward. So thank you all of you, Arjun, Pradeep, Devlina, Anil, Raul, and Albert, for a wonderful session. Thank you very much, and thanks Kirti for the opportunity, and to all the members of Access India team. Thank you.
Thank you, Heminder. Thank you, panelists. And I apologize because we're really running short of time. And thank you once again for such a very insightful session. And we will now reconvene for the next session in some time on a session titled Mitigating Agricultural Risk, Meso-level Insurance in Agriculture at 4:15. Thank you, everyone.
Thank you.